Seventh floor.
We'll see you around the timeline. Feels good to be back.
I think The Rollup is one of the most premier media brands in crypto, and Andy and Robbie are great experts at everything they talk about, and it's my favorite podcast.
Adding it to my library as we speak.
Potentially multi-chain deployments.
We are at DevConnect Day 1 here. I'm with Jesse from Base. JP Morgan, BlackRock, DTCC, Fidelity, the entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it, he finally said it.
I'm so bullish.
Andy's bullish, I'm bullish, we're bullish. Is headed to the top. If we're not already at the top, we're going to the top.
We're going.
The Rollup is my favorite.
From all walks of life, all over the world, all over this industry, come together for The Rollup.
Zoom out. The institutions aren't coming. They're simply here. It's the golden age of crypto, guys. Get right. Let's go.
See you on the show.
Ladies and gentlemen, you are watching The Rollup live from the Tokenization Tower, the nest where digital assets meets finance. It is May 28th, a beautiful day in the city, beautiful day down in South Florida.
We got the tokenization tower and we got the tropical tokenization paradise. What more could you ask for? We are running the gauntlet all the way up the Atlantic Northeast, the Atlantic coast.
Aton's looking for a sub $40 entry on Hype. Per just raised $50 million for the DATCO. Thread guy closed his Zcash position. We got Zcash bears on the timeline. I don't know what's going on out there. Rob needs near to pump bad. Guy needs a new light bad, so he needs this near pump to really come through.
Oh my goodness. My near position is looking great. I mean, up 33% this week.
I can't believe our lovely in-house hard-working Aton has the audacity to tweet he's looking for entries sub 40 on the best performing crypto asset of the year.
Yeah, it's pretty incredible.
It's pretty incredible.
Meanwhile, he's on the sound effects, absolutely ripping.
All right, ladies and gentlemen, welcome back to the tower. We had a sick episode today. If you guys are on YouTube, I'm seeing you guys in the chat. Hit us with your questions, thoughts. We'll respond to you. If you guys are on Twitter, same thing there. And yeah, first of all, as always, shout out to Plume. The Nest by Plume, bringing on-chain asset management to fruition with their Nest Vault product. We're in the Nest. We're in Plume's headquarters, so we're here.
So the headquarters vault tokenization. I don't think you can just strap that into Plume. I think the entire world is getting tokenized. The entire economy is being tokenized, and it's happening out of that building.
Out of that window.
It's happening right outside that window.
It is.
And we are at the forefront. Feels very good to be at the forefront of this, covering tokenization, on-chain finance day in and day out. Wouldn't rather.
Yeah, some days it feels good. Some days it's bearish. So
I don't know. Have we really had a bearish day for tokenization?
No, not really. No. Guys, welcome to the tower. We got Moonrock Capital's founder joining, talk about his robotics investing, his AI investing, his crypto investing, and what he's seeing on the venture side. Our fund has not really done a check in a long time, so we're not really active right now. So kind of curious to see what he's doing, if he's active. I mean, we've seen some cool deals, but then we got Stablewatch founder. They just launched this Osero product, a stablecoin yield product, super cool. That is actually one of our portfolio companies. And then we have the Bitwise head of research, as well as Joseph Chalom. Hype back above 59, vibes are up.
Hold on, I want to cover just on our
Treasure
guests very quickly today. I think Joseph Chalom coming onto the show is very, very interesting timing. Like there is so much shenanigans happening at the EF, happening with Ethereum in general. And this guy is the second largest DAT company. He holds a boatload of ETH.
Yeah, 840,000.
And Ethereum feels like a ship without a captain. It feels
that's a bold take for an Ethereum bull.
I mean, it feels like the entire EF has left. Bitmine is the one that would pick up the pieces. Joseph Chalom can pick up the pieces. I've been on multiple panels with Joe Lubin. He feels like he's stewarding the ship, but where are the leaders of the Ethereum ecosystem? For so long, we've heard how decentralization is just not really able to build a cohesive strategy amongst this ecosystem. Obviously, it's got strengths and weaknesses, but I think that's going to be a very, very telling conversation with Joseph Chalom today.
No downtime. That's what matters, ladies and gentlemen. No downtime. Our topics today are powered by Trezor, Trezor.io. Use code ROLLUP10 to get your hardware wallet across every chain, every asset that you want. Let's get into the markets and weather. Before we do, let me tell you about Frax, our premier stablecoin partner. Open, stable, borderless, building the infrastructure for the future of digital money. Visit frax.com to learn more. Robbie, it's a beautiful 73 and a little bit cloudy today in New York. How's it looking down there?
It's beautiful today. Down here in Florida, we've got this this kind of boiling over effect every afternoon for about 30 minutes. We get a little rain, because it steams over. It's like a boiling pot of water. And so you can expect a nice shower here in a few hours. But right now you can look out the window. It's pretty sunny. It's feeling good.
Good, man. Good, man. Our weather, as per usual, powered by Relay. Visit relay.link for your best cross-chain swaps available on the market today, now on chain. Let's get into the markets. It is a little bit red out there for your select assets. Before we do, let me tell you about our tokenized equities partner, Denari, powering U.S. equities on chain. Infrastructure for tokenized U.S. equities and bringing real-world stocks on chain. Visit denari.com to learn more. Rob, it is red out there. It is red out there. Solana's holding on for dear life. Bitcoin down again. Bernisky put out a tweet saying that he does not think that there's going to be a so-called rotation higher from the new up-and-comers, rather that the majors are telling us something and people don't want to listen.
You know what I find interesting about Chris's... Yeah, go ahead, finish that thought.
I don't want to listen to the majors. Send hype higher.
You know, obviously Chris is, very well respected. I also love how Chris, has been tweeting a little bit less frequently, because it feels like in these kind of markets, you just need one idea to stay patient and ultimately proliferate that.
Yeah.
The market is so full of so much noise that it's almost better and more effective to have less thoughts, less ideas, and just have a very high hit rate on big ideas. So I think
100%. Yep.
So
if we didn't have this business, I'd be surfing in Indonesia in a money market fund and waiting for about another couple months to be rebuying. But of course, here I am running this business.
I don't think it's the business that's forcing you into the market.
I think it is.
I don't think it's the business that's
I'm looking at the market every day.
Companies. I don't think it's that. I think we can stay patient here in
I
spot.
cannot wait to talk about Per. All right, guys. Today's digital markets powered by Zama. Coming up, they're pumping right now a little bit. Private payments, private transactions, private assets, all on chain. Doing things the right way.
Before we move off of Chris's tweet here, I think it is relevant here to the markets, where he says, I don't see a paradigm where majors are rotated out of and select up-and-comers can sustain their swim against an ongoing tide for long. I think majors are telling us something. People are finding reasons not to listen. Obviously, majors, he's referring to Bitcoin, ETH, Sol. Essentially, that's it. My stipulation with this tweet is equities are a major asset class and they continue to push higher. And so I agree that, Bitcoin and ETH are forecasting out and they're trying to tell us something, and maybe we're finding reasons not to listen. And maybe Chris is right. But if that's the case, what are equities telling us? Right? It feels like, Bitcoin is kind of holding and kind of dwindling down a little bit, and that's telling us that there's cracks in the foundation. But at the same time, we're looking at equities push higher, and for some reason, it's just disbelief, and we're, again, thinking that this is just cracks in the foundation.
Well, dude, you cannot have a pumping market without a healthy pumping Bitcoin. So that's what it, like, and if anything, equities pumping and Bitcoin not is also telling you more that something's wrong here. Chris calls it the macro, or the most honest macro asset, Bitcoin. Meaning that a lot of these pumps are kind of like dishonest given the state of the world.
So
outside of
I'd be curious to hear more about why Bitcoin is a more honest macro asset despite its lower market cap to equities.
I don't know. Maybe we'll get Chris on after his sabbatical. Let's keep it rolling, ladies and gentlemen, into the lovely news. Before we do, let me tell you about Near, the blockchain for AI, powering autonomous agents and AI native applications. Visit near.ai to learn more. Wall Street Clearinghouse, DTCC, says it plans a connection between tokenized securities platform that they are building. Shout out to Alpaca and Stellar. People are caught way off guard by this, saying Stellar is an old 2017 chain. There's other 3-letter crypto tokens that are kind of bucketed in with Stellar, Rob. And people don't really realize that Stellar and Avalanche, of that kind of like OG cohort, are doing far more on tokenization and institutional adoption than a lot of chains are. Like there's this bifurcated path, Mega ETH, Solana even to some extent, but not as much, Base even to some extent, trading on-chain consumers to the max, and institution RWA, that's happening. There's a kind of like this like split path happening, I think. And Stellar obviously was with the government of Bermuda when we were there a couple weeks ago. now with the DTCC, I mean, they're doing something right.
I completely disagree. I think this is an absolute nothing burger. I think Stellar is one of many blockchains that DTCC will launch on. Even in this article, it says DTC's tokenization service to connect with Stellar as it advances its multi-chain strategy. I think this CoinMarketCap post is lacking a disclosure. It was maybe paid by Stellar. I think Stellar is taking an RWA path. I think it's trying to focus on taking a more institutional route. It's essentially a poor man's Canton. I think the DTCC is going to launch on several blockchains. They decided to announce this thing with Stellar. I can read the quote here. It says, this collaboration represents another step forward in DTCC's efforts to build an open, interoperable digital infrastructure that bridges traditional and digital markets. That was the chief executive officer of DTCC, Frank LaSala.
Wow.
There's a lot going on here in this article, but it really doesn't call Stellar out with too much. It does say that Stellar's proven track record with institutional assets on chain is an important factor in our evolution of blockchain networks. But Stellar is one of many chains that we can expect the DTCC to enable with tokenized assets. It does say that they're going to collaborate going forward, but we saw the tokenization service. It's planning to get rolled out in this summer, and it's going to roll out. I think we saw 50 plus partners that they're learning and figuring out best practices. I expect lots of chains to be part of the DTCC rollout later this summer, and that ultimately expanding to a multi-chain strategy. Stellar making up one of those chains.
Guys, I see you on YouTube. Almost 20 of you guys. Say what's up in the chat. Let us know what you think about Stellar. We're going to pull into Ilya and Ethereum Foundation. Rob, this kind of gets to what you're saying here with how the EF has evolved over time. So let's get this up. Ilya tells a story, which I don't know if anybody actually is aware of this, but they, Near kind of like spilled out of Ethereum in 2018. They wanted to build scalable infrastructure for AI-focused applications. They really were trying to build sharding with like the original roll-up roadmap and also build more like tech on top of Ethereum. The EF was like, no, you just go build it on your own. So let's actually hear what Ilya has to say here.
So, I mean, we have a long history with Ethereum because we actually pitched in 2018 to build these two to Ethereum Foundation. Because I actually, like, if we could just build these two, make it work, we would go back to AI in like 2020. And because that was like the whole thing. We're like, we needed a blockchain for our near AI stuff. And we're like, looked around, we didn't find anything that would actually match our needs, right? Scalable, easy to use, kind of abstracted. And so we were like, okay, well, Ethereum is, was talking about sharding back then, was talking about WebAssembly, was talking about, faster slot time, was talking about better user experience. We're like, cool.
WebAssembly. You don't hear that very much in Ethereum land these days.
And so we're like, cool, we can just build all that. We have a team, we're VC funded. We just need an upside. That was the thing. It's like, hey, we need a way.
Oh,
like,
whoa. Sorry, I'm going to stop you right there. So, I don't know if you're familiar.
Oh my gosh, dogging Ethereum.
Communism, but we're not paying you shit. You can build up the two, but we will not pay you a red cent, my friend.
And so that was kind of where that conversation went. And so to be clear, like I've pitched this idea multiple times. So like before launching mainnet, I've pitched it again because like, hey, look, we've built it now. Right, we had mainnet, we had sharding, we had WebAssembly.
We de-risked all of the execution.
Yeah, we had a kind of abstraction. Let's figure out like what this could look like. We do have VCs. We need to pay them money. I have a team that wants upside. They work 24/7 effectively.
Why would you have VCs? What were you thinking?
Yeah.
So
well, that's the story, man, and that's how Near was created, and that's why they end up creating their own chain, and it was a part of that kind of like early L1 trade, and that happened.
I think it just goes to, I think it's important to remind people that Near is effectively an AI company, and this entire blockchain, evidenced by this clip, is effectively a side quest. Like they didn't start out to build a blockchain themselves. They were just going to build it on Ethereum, but they needed a blockchain that was able to do sharding in order to get, you know, enough block space so that it was able to be performant for AI. Their initial focus and their main focus is AI, and which is why I think we're seeing a lot of the products come out now. But it just, again, like it's not the first time that Vitalik or the EF has been called communist. They don't pay for these sorts of things. They expect people to just kind of come along. And it's funny because now, you know, just yesterday we were talking about Hyperliquid not paying for market makers, not paying for listings, not paying for anything. It's just incentivizing people with the strength of its own product and the strength of its own token. Ethereum has done that and taken a very similar path. And their product in the blockchain has been so strong that it has incentivized people to build on top with no additional cost or financial incentive that they will have to pay. That has been both a strength and a weakness, and it's led to Near kind of going out and building things on their own rather than kind of internalizing that. So it's funny. Usually it's most difficult to get that early on. The fact that ETH and Hyperliquid have been able to succeed at bootstrapping this without any additional financial incentives, I think is huge for the ultimate strength of the ecosystem. And it just goes to show that the toughest times of both of these ecosystems are behind us. And I think a lot of this is now about reaching size and scale. I do think that it's important to stay open-minded and adapt some of these policies as these things grow. There's obviously a ton of resources. The Hyperliquid team and foundation has a ton of hype. The Ethereum Foundation has a ton of ETH. These are resources that they can apply to the betterment of the ecosystem itself. Sometimes it's not great to just buy back and burn, ETH. In the case of the Ethereum ecosystem, it might be more effective to say, hey, we want AI products on top of Ethereum. Let's take this ETH, not burn it, but apply it, or give it out as grants, or do these things so that we are using the financial resources for the betterment of the chain. I realize that it's maybe antithetical to the ethos to have some sort of elite group that is deciding how to allocate these resources.
It is.
But if we codify this, I mean, think about like the spirit of, the DAO back in 2016, it was hacked, yada, yada, yada. But the idea of that was to programmatically allocate these resources. And so if these things are applied and allocated by code, all of a sudden, it's not communist. We codify this. We have a governance process. We're able to allocate the resources for the betterment of the ecosystem. And it's not one person or some elite group of people that are allocating these resources. It's the code of the ecosystem itself. And I think that helps to avoid just burning these resources. And it helps to avoid the centralization at the top of the totem pole. So I'd still like to see some of these ideas put into practice.
I hear you. And I think maybe Rob's going to go and be the next EF director. He's going to leave the roll up and go be the leader of the EF. Ladies and gentlemen, your new EF director, Rob Collages.
This is my, come on. Round of applause for the campaign. My campaign for the chief dictator of Ethereum is built on AI overlord governance. I want to implement an AI system that is able to make all the decisions with how we allocate our ETH, and we can make Ethereum great again.
Ladies and gentlemen, give it up for Rob, the new EF Foundation creator. Let's get on to the next piece. Let me tell you about Infinify, DeFi infrastructure for simpler access to on-chain yield, liquidity, and capital allocation to explore more efficient on-chain finance, higher yields, no leverage. Visit infinify.xyz. Orbital raises $50 million in a Series B led by Plural Platform, NASDAQ, or NVIDIA Ventures, Radical VC, Compound VC, Fly VC. It is AI-designed materials and modular infrastructure for next-gen data centers. So a lot of these data centers that are doing, a lot of these data centers that are doing AI data center GPU farming were previous Bitcoin miners, and they have cooling fluids, faster to deploy compute systems, and basically their entire business is ran around how do you lower the time of launching a data center and like building a data center or launching a data center and playing it out? So don't really have much here, but wanted to highlight it. Congrats to them. This sector is going to have trillions of dollars of investment. Had a conversation with the Milk Road guy yesterday. They launched Milk Road AI. I don't know, man. Maybe there's a roll-up AI coming to you guys soon. Not sure, but you know, it's just happening. It's just happening, and it's just going to keep happening and keep accelerating. So you kind of got to love it, and you also kind of got to wonder when there's ever going to be a bid that returns to crypto. So
let's move on. We still got plenty of news to cover.
Yeah, let's get it. All right, Falcon Finance teams up with Anchorage to issue FUSD, a Genius Act compliant payment stablecoin. I put that in quotes because I don't think that Genius compliant is the right way to advertise this from CoinMarketCap. I don't know the specifics, but without the Genius bill actually implemented, at best, you're at a Genius compatible level with these things. But yeah, this is the regulated counterpart to Falcon Synthetic USDF stablecoin and their ecosystem there. And I mean, look, guys, this is going to keep happening. This is just going to keep accelerating more and more of these stablecoin products, these types of new yield products on chain, this time in line with the Genius Act.
Yeah, not much more to add here. I think it's semantics, compliant, compatible. I understand Genius Act still needs to go into law, but I do see more and more of these Genius compatible payment coins, payment stable coins popping up. We talked about SoFi USD yesterday. I think we're going to get our friend of the show, Stabled Up sponsor Frax and co-founder Sam Kazmanian on the show. He's going to talk to us more about Genius Act, Clarity Act, everything going on with stable coins. I think he's coming on next week, so excited for that. Otherwise, stable coins just continue to proliferate. We're going to see more and more stable coins. This is not slowing down.
Guys, don't let the sentiment get to your head. You're never going to see hype under 40. Don't let that, just stay true to yourself, all right? Stay true to yourself. If you're in hype, you're in near, you're wondering what Zcash bounce is going to do, if Bitcoin's going to zero, just stay true to yourself. Manage your risk. The situation is fine.
Uranium
Hype's going to
is
75.
Uranium's going to do great.
Next.
We're still in
Hype's going to mid 80s.
We're still in a nuclear deficit.
Yeah, that's going to take 30 years
There's
to play
a shortage.
Hype's going to 25x before we even have that shortage. Let's get into the next topic. Before we do, let me tell you about LeFi, building infrastructure for cross-chain swaps, bridging, and routing across the on-chain economy. Explore smoother cross-chain execution. Visit Lee.fi. Michael Saylor was asked why Bitcoin hasn't been getting the same momentum as stocks and what catalyst could break the heavy resistance ahead. Stretch today, Rob, is pulling down under that dollar mark.
Yep.
So guys, Stretch is meant to stay at $1. It had a crazy wick. Somebody wicked it all the way down to 97.1. It's now trading at 98.8, meaning basically Saylor can't do much right now with Stretch until that thing gets back up to 100. Let's hear what Saylor has to say about the geopolitical pressure, what's happening with Bitcoin. I think it's kind of obvious to us, it's 4-year cycle things. It's positioning and hype and see you at $85 type of thing. But let's see what our guy here has to say. Maybe he's going to...
I think a lot of my guests that I've been speaking to have been wondering why Bitcoin hasn't been gaining the same momentum as, say, stocks, for instance, which have continued to hit these record highs. And I'm just wondering what the fundamental catalyst would be to break through that heavy resistance we're finding just north of 80K right now.
Yeah, well, stocks are beneficiaries of the AI trade. There's a lot of capital flowing into the equity markets because of enthusiasm around AI and tech. That capital has been drawn out of the crypto market to a certain extent because many Bitcoin miners have been rotating into AI, high-performance compute, and they've been selling Bitcoin or they've been refinancing their Bitcoin to do that. So that's the headwind. Really, the drivers for Bitcoin right now will be macro. As we start to see a loosening monetary policy, that'll be very good for Bitcoin. A cessation of or a lessening of tensions with the trade wars and with the hot wars in the Gulf. Both of those are good. Bitcoin's driven by geopolitics. For example, crypto billionaires out of China, out of the Middle East, out of Asia, out of Africa. And so when they feel pressure, sometimes they're selling. It has nothing to do with the U.S. equity capital
this
markets.
helps to answer the question that we were left with as a result of Chris Bernitzky's tweet.
Yep.
Why Bitcoin is a better forecast of global monetary policy than potentially the equities market. It's because it's less noisy. Even though the equities market might be higher market cap, maybe a better signal for the U.S. economy, it's not as pure a signal for global monetary policy and the health of the global economy. And so I think Chris is absolutely right. And when we look at Bitcoin and try to think, what is Bitcoin telling us? It's giving us an indicator of the health of the global economy, whereas stocks don't quite do that. So yeah, I think, and you know, the next tweet that we have coming up with regards to the Bitcoin ETFs, I think is also playing into this. But I think Saylor's absolutely right. He's also talking about looser monetary policy. You know, we have Kevin Warsh's first Fed meeting coming up in 2.5 weeks. A little bit longer, just about 3 weeks. That's when we're really going to get a sense of how dovish or hawkish Kevin Warsh is. And, you know, Saylor's a little bit presumptuous, in my opinion, about the looser monetary policy. We don't know how dovish Kevin... I mean, am I wrong? I don't know. We've kind of gone back and forth. Obviously, Trump picked Kevin Warsh for a reason. Trump is looking for dovishness. But Kevin Warsh is not the most dovish pick that he could have picked. So we really don't know how dovish or hawkish Kevin Warsh is going to come in at. Obviously, it's not all about interest rates. The Fed funds rate for the next decision coming up in June, 98% priced in at no change.
Yep.
So we know effectively.
I mean, Trump's going to be on his ass, though, to change these things. So
yeah, but I think there's more tools in the Fed's back pocket, and in terms of the mechanisms and levers that they can pull to ease monetary policy. It's not just about interest rates. And frankly, Arthur is the best person that talks about this because, you know, he mentions things like, you know, adding bonds and, you know, corporate, you know, equities and markets onto the Fed's balance sheet. That's a way to ease. There's SOFR, there's all these kinds of bank regulations and reserve requirements that they can ease as a form of loosening monetary policy, allowing more credit to be created. The thing is, we're not seeing that reflected in Bitcoin. You'd think if Kevin Warsh really is...
because it hasn't happened yet.
But isn't part of, you know, Chris's theory that Bitcoin is forward-looking?
Sure. Until we get rate cuts and people like going ballistic about Bitcoin, people are just going to kind of like... Dude, there's no reason to buy Bitcoin right now. Like, why would you buy Bitcoin right now?
If you think that Kevin Warsh is going to cut rates, he's going to ease monetary policy, and that's going to propel the price of Bitcoin,
then people would honest macro asset, because if the number of dollars in the systems goes up, Bitcoin will just go up over time. But like, there's so many other asymmetric opportunities right now. Like there's so many others.
I'm trying to make room for Chris's thesis as well as ours. And what you're saying is that there's room for other assets. And I think you're right, but I think that contradicts Chris's thesis.
I don't know. I think that like you can just go and buy a Micron or Snowflake because they announced they're doing a $6 billion deal with Google and you're up 30%.
I mean,
like, why would you buy Bitcoin?
That works as well.
But I mean, does it ever? Apparently it's been working.
Yeah. So why would you buy Bitcoin? I mean, if it does feel like this AI trade is happening in a bubble, irregardless of the macro policy.
For sure.
Right. And so if you're confident about, you know, the AI, and we also heard how the only thing that is going to put an end to this AI vacuum trade is an anti-AI political regime. And so this continues to happen.
AOC 2028.
Right. And so if this is happening irregardless of macro, then I think you're right. I think you can go into AI. It's going to happen no matter what happens with the war, no matter what happens macro, no matter what happens with monetary conditions. But if we get this perfect storm, monetary conditions ease, and you get, you know, this pro AI trade happening, that's where I think we could see some explosive numbers. if we don't get the macro conditions, then you have the risk of this pulling down the AI trade. And it's just a matter of which one is stronger.
I got you. I mean, I think the AI trade continues. That's what we know.
That's why we're seeing the stock market rip and we're not seeing crypto rip except for some of these choice AI products. Right?
It's going to, I mean, it continues to rip. But I mean, we shall see. All right, guys, we're going to get
until macro
Simon
makes a change.
Well, yeah. I mean, until like any macro change should be bullish for Bitcoin and equities. So
any looser monetary conditions for sure. For sure.
Yeah, we're gonna get Simon Dedic, the founder of Moonrock Capital, up. He's been doing some interesting things in AI, robotics, crypto investing as well. Obviously, founder of Moonrock Capital. Should be a good segment. They are established in Munich, in Germany, in 2019. Simon's a German entrepreneur and investor, deep in robotics, tokenization, infrastructure. There's a lot going on. Let's get Simon up on the show and keep these things rolling. Simon, welcome to the show, man.
Hey guys, pleasure to be here.
How are you, man? What's going on?
Oh, good. How about you? Thanks for having me.
All good, man. Are you going to be in New York anytime soon? You got any conference travel planned?
I am considering right now, actually. I mean, permissionless is happening end of June, right? So I definitely enjoyed the conference last year. So I'm currently considering lots of stuff going on, actually.
Nice. Yeah, there's ETHConf in a couple weeks. There's I don't know. The conferences so far, first half of the year, have been quite different than the previous conferences. There's been a lack of the degen in the air, if you know what I mean.
Yeah, totally. Yeah, I definitely agree. I mean, one that I will be at is like next week in Paris. I'm not sure if like you guys will be there or like anyone listening is going to be there. But it's called Proof of Talk. Actually, it's not well known, but I can definitely recommend it. I mean, it's happening in the Louvre. It's being organized by some friends out of Germany here, and very, very pleasant experience. I mean, the quality of people there is incredible, and it's like one of these very few European conferences that actually manages to kind of like fly in people from the US and out of Asia, right? So it's kind of cool.
Well, Simon, we wanted to pull up a couple last things that we wanted to go over for our audience and with you and get some of your take on that. We're going to pull it up. The first one is that IBIT saw the second largest daily outflow. I don't know if you saw this on Twitter the other day, but if you look at the screen, you should be able to see it. And there was a $1 billion market sell that happened out of nowhere on IBIT, which is the largest Bitcoin ETF. There was a daily outflow about $528 million. Bitcoin was down maybe 1 or 2% on that day. And yeah, I mean, it was just a very, very interesting sell. And the largest one ever. And then obviously kind of like Bitcoin's been a bit down. These ETFs have been swallowing a lot of the supply. They've been kind of changing the dynamic of investing in Bitcoin. I don't really look too deep into this, guys, but it's definitely something to note as far as like this is like the second biggest day of outflows ever.
Yeah, I think I'm pretty similar to you guys there. I mean, I don't look at these things like too closely. I mean, for me, this is usually just like the market being the market kind of, right? I mean, it's definitely not great signal. I mean, it was kind of obvious that at some point, like after all this like great buying that like all the ETFs and like also the debts brought, there's also going to be selling. And I mean, I think this is also just kind of reflecting that right now, like many institutions and like many backholders just don't really know like why they should be bullish here right now, right? So, but I think I don't care much about these things. It's just the market being the market. And I'd rather like focus on our kind of like long-term investments and stuff actually building things.
Yeah. Yeah, I find it peculiar, but it seems like these ETFs have been swallowing a lot of the flows. Both, Bitcoin obviously, with this sale, but also Hyperliquid has seen a lot of flows through the recent hyperliquid ETFs. Simon, how much are you paying attention to liquid markets? Like you said, the market just being the market versus focusing long term. The VC landscape has changed significantly, over the recent months as well. When you kind of look at things and you're forecasting and you're thinking about building a thesis around VC, how much do you pay attention to the liquid market to kind of tell you, okay, let's pay attention here, let's pay attention there?
Yeah. So I think it's given that we are still a prop fund, right? We have kind of like a hybrid structure where we do kind of venture deals, but we also run a liquid book. But I think it's important to mention we are not traders, right? I mean, when we are talking about liquid investments, then we are basically finding kind of undervalued gems on the market, and we find projects that in our opinion are massively undervalued, and then we just kind of accumulate them. It's not like that we are paying too much attention what Bitcoin and ETH is doing in the short term, and we are trading it or something. I mean, obviously we have our guys that are following macro, right? And we have our general view on whether we are long-term bullish or bearish the market in general, right? But overall, we are trying to be venture investors, being very long-term focused, and usually then these things become just way less relevant.
Yeah, I agree. I mean, you do have to have a kind of a bigger picture view, and then you just got to kind of ignore all the noise. I want to pull up this next one. Grayscale is finally getting their hyperliquid ETF ready to go. They just filed their amendment number 4, so their fourth S1. The filing includes planned 2 million total hype token seed investment worth about $100 million, $113 million. The ETF is designed to combine hype exposure with staking yield. On yesterday's show, we talked about how the total supply of the ETFs has already swallowed up about 1.15% of the hyperliquid market cap just in the first week or so. Simon, give us your hype take, bullish, bearish. Where does this thing trade? How are you reading this kind of institutional wave of adopting hyperliquid finally?
Yeah. So look, it's a very difficult topic for me because I'm hyper sidelined basically, right? So I made a very, very stupid mistake in the beginning to kind of see hyperliquid as just another perp dex, right? And I was very much mid-curving it and basically saying there's GMX and all these other perp dexes already. Why is hyperliquid so special, right? And I kind of got sidelined. And then it was running, and I thought okay, it's kind of cool, but now it's way too expensive. And then I obviously also didn't buy when it dipped. So I will hyperliquid will just be this asset for me that where I will always be hyperliquid, and I regret it quite a lot. Because I think what's happening right now is super cool. I mean, obviously. Of course, they are printing a shit ton of revenue, right? And the metrics are very impressive. But I think what's very cool about hyperliquid is that they are one of these very, very few use cases that manage to kind of break outside of the crypto bubble, basically, right? So basically just as Polymarket and kind of their moment with the election, and people realize, okay, prediction markets are kind of this new marketplace where we can price events and information asymmetry, right? I think it's very obvious right now that hyperliquid is just opening the eyes of a lot of TradFi, Wall Street suits, and how great it is that you can price pre-IPOs, right? Or how cool it is that you can trade oil on the weekend when the war is starting. So I'm super, super happy for hyperliquid because I think they are bringing more eyeballs to the crypto landscape. And I think they are one of the very few who managed to kind of just grow the pie again, right? So yeah, I'm very bullish hyperliquid, even though I'm sidelined, and I think it's pretty cool to see these stats going live and actually catching quite an institutional bit as well, because Wall Street just has it on the radar and they want to buy it, right? And So we have debated a lot internally already whether it's going to flip Solana and Ethereum, right? I think fundamentally it makes sense, but it's still very hard to kind of like forecast.
If hype flips Ethereum, oh my God, I'll be insufferable.
I mean, it doesn't necessarily mean that hype is pumping to like $1,000, right? It could also mean that ETH is dumping to $100, which is probably rather the consensus take right now.
Yeah. Don't tell that to Rob. Guys all in over there. All right, let's move on. Last one here for you. So this is like kind of getting to like the DAT versus underlying versus ETF conversation. Hyper Strategies, HypeStrat, bought $1.5 million or 1.5 million hype last week, while its cash increased from 114 million to 157 million. So added about $43 million of cash. They probably issued and sold more than $130 million worth of per shares through the ATM, which is this kind of beautiful thing about DATs that we all were excited about back in the day when, you know, they were starting, where you could issue shares, sell the stock, use the cash, buy more of the underlying, kind of creating this reflexive pumping flywheel. Obviously, you know, these inventions would have been better at the bottom than at the top. And so yeah, Per is cooking. These guys are have a nice MNAV 1.18. 1.19x. They've got $160 million of cash. They've got 22 million hype. They are creating more value per share than owning an ETF. I own a lot of Per, but also at the same time, they've kind of underperformed hype in the last couple, let's say a week, because they've sold a lot of the shares to raise more cash to buy more hype. And so it's kind of an interesting dynamic here. Simon, curious, how do you think about these DAT companies, this kind of like ATM flywheel? How do you reason about buying, you know, something like a Per or like a MicroStrategy versus a Bitcoin or a hype?
Yeah. So like obviously we are crypto native investors. Like we would never ever kind of like touch a DAT, right? I mean to us it just doesn't make sense when you can also just like own the asset directly. I don't know, like we are not big fans of DATs. So I mean, obviously, I mean, they are kind of like Ponzi schemes, right? So I mean, they are great for the market, like when it's in up only mode, right? And they're like a great accelerator of this, and the price going parabolic then due to them. But the problem is like it's also going the other direction, like once the whole kind of like Ponzi scheme breaks, right? So I don't know, like we also see like we had like a lot of chatter already around like MicroStrategy and MicroSaylor, right? And obviously like once this model breaks, like the market is getting like very, very afraid that we can go down like much faster than we actually went up. So I don't know. I definitely see how great those DATs are to kind of like make those assets accessible for like Wall Street and like non-crypto natives. But I think it's always kind of like a bit dangerous. And I would prefer if we rather go up slowly but surely, but like more sustainably, right? By actually people buying it spot rather than like with these leveraged Ponzi mechanics. But I mean, let's see. For now, it's great. Let's see.
I just would hate to get a trade right, but for like the ecosystem to do well, but the company itself for some reason, like, you know, we've seen how sometimes this happens, and it would feel so awful to get the trade right, but the company that is the vehicle for the trade is wrong. I don't know. Andy, how do you reconcile something like that happening?
Dude, it's going to feel better to get the trade right and to have Shamus absolutely executing like a savage, which he's clearly proven he can do at scale, not buying the top like all the other hype DATs or all the other DATs, selling at all-time highs, raising cash, buying more hype on a dip, Dude, the guy's dialed. The guy lives over here in Sands Point. Tom knows. We're good, man. Rob, just worry about your ETH position, all right, man? That's all you got to worry about over there. All right, let's bring Simon back up. Simon, let's talk VC, robotics, AI. I know you've been doing a lot there. What have you been doing, man? Have you been doing deals this year? We've done like maybe 3 deals this year. We've been on absolute pause. The entire founder archetype is shifting. The entire kind of what actually accrues value in the industry is shifting. The whole musical chairs is beyond up. Happens every cycle. Feels more real this time. What is Moonrock doing? What are you guys seeing out there?
Yeah, definitely. I mean, maybe for full transparency, like we are currently quite swamped because we are also preparing our own fundraising mode, kind of, right, which is kind of like eating up a lot of our time. But we are still actively looking at deals and we are still actively investing. But we also haven't like invested like a shit ton over the last few months. I think the most recent deal has been like Blockworks, which we think is like quite a cool one that we are very proud of. So I think you guys are still there. Mm-hmm. Yeah. Okay. So I think the problem is the problem actually is like a good thing, but like the market is consolidating quite a bit, right? This also means, in my opinion, it's getting like a bit more boring on the venture side, which doesn't necessarily mean this isn't like an opportunity. So I think like what I'm talking about is like you guys should know this as well, right? I mean, a few years ago, like in the last cycle, like we were trying out kind of like everything. Right, we were trying to bring like everything on chain, and everything was like super experimental, and like there was like new stuff going on every day. And this was obviously while like most of these deals are now quite underwater. Obviously, it was like a very interesting time to deploy. I mean, the kind of like the bullshit phase is kind of over right now. Like we see the market consolidating towards the winners. I think we've learned over the last few years, like what the kind of use cases are that actually make sense, and what the kind of use cases are that are worth doubling down on, like stable coins, prediction markets, perp dexes, right? And I think this is what we are seeing in the private markets right now. So we are seeing a lot of the same stuff. Everyone is building like neobanks right now. Everyone is building on top of prediction markets, right? Which makes sense. I think there's still like a lot of opportunity there. It's just not that we see like so much innovation right now that we are dying to like run one check after the other. But what I also would say is like what is like a very positive signal like with this consolidation is that we are kind of like filtering out all the moon boys, all the tourists, right? And at the same time, like who is left are actually like the very, very solid founders. Who are doubling down on the industry and who actually are still here because like they believe in what they are building and they believe in the industry long term. And we definitely see this being reflected already in our deal flow. Like we would say that the founders pitching us are way more solid than they have been like a few years ago.
Yeah. And is the firm doing stuff outside of crypto as well now? Like, I mean, I know you guys have been like doing robotic stuff and AI things, and it's been of interest to you. What's the balance between crypto and not crypto stuff?
We are still pretty heavy on crypto. So we are definitely also interested in stuff outside of crypto. I mean, obviously we are buying stocks to some extent, but this is like rather personal accounts. And then like we did some robotics investments just because like we are very, very bullish on the vertical itself. And then we have like some crypto companies who are pivoting to being AI companies now. So we are also AI investors now. But no, I mean, like we definitely see ourselves as like crypto investors. And this is like where we have our expertise, where we have our edge. And we're still doing like 95% like crypto investments only, I would say.
Good. Yeah. I mean, I think all of the infra and the chains and the interop and the ZK and the modular and the fast L1 and the all of those are just so liquid staking, restaking. I mean, you can just keep naming them. There was such a narrative, a forced narrative loop last cycle, and all of those deals and all of those tokens are just completely crushed.
Totally. Yeah, I think like what we are very happy with is that the market is getting smarter right now, and maybe it's also like a bear market thing, right? But we have like this revenue meta at the moment, like we're like getting completely crazy to focus on actual businesses. But I'm actually so sick and tired of kind of like talking about weird tokenomics and talking about like the monetary pieces for like Ethereum or something. Like we just want to focus on like great founders building like great things that actually like solve problems and that generate revenue like actual businesses, right? And I think a great example of this is one of our portfolio companies, Collector Crypt, that we have backed a few years ago.
They're ripping right now.
They're like one of the best performers like over the last few months, I would say. Like they're incredible. And the thing is like, first of all, like the founder is like very, very committed. Like he has been like a collector for like 20 to 30 years. Like he's building this because he believes in it, right? And he actually wants to solve a problem. And secondly, he is like really solving a problem. So there are people like willing to pay for it. And it's like one of these very few cases where like building on crypto rails actually makes sense. And I think this is like currently being reflected in the revenue. I think they're doing like more than 100 million of annualized revenue. And this is also being reflected in the token at the moment.
Yeah. I mean, I saw that, and that $40 million market cap, that trader Blunt's guy is calling it one of like the most easy, undervalued trades that he's seen. You agree with that? You think this thing has like a 5x in it?
So look, I'm very biased. So like we are very proud because like we have been like literally like one of two investors who dared to kind of like pull the trigger on them in 2024. Like no one wanted to back them, and like everyone passed. They actually didn't even close the round, and now they're like one of the best performers. So the thing is, like, if you look at their revenue numbers, if you look at like the actual TAM, I definitely think they have like a lot of upside. I'm a bit careful like what I'm saying because I obviously know about their plans and what they're already working on, right? And obviously this is not financial advice, but I truly believe they could become a decacorn, right? And right now they're sitting at like, I don't know, 300 to 400 million FDV. I think it's like how I see it, it's like this is kind of like the NFT market right now in just like a way more sustainable and a way better way, right? Because what we are selling to people is kind of like, let's say, collectibles and Pokemon cards. It's stuff that people already know and that they're used to, and we just sell them like a much better version of it. It's not like we are trying to sell them like an ugly JPEG of an random ape or something for six figures. But we are selling them like stuff they love and they can actually relate to. And it's a huge market. And I think it has like massive potential to pull in like a lot of people from outside of crypto, right? And who don't even care whether they're interacting with crypto. And I mean, we are seeing this already. I think Collector is like the second highest revenue generating project on Solana right now.
It is.
Right behind Pump Fun. And I'm very happy for them because like they really earned it.
So what do you know? What do we need to know?
So let's say the alpha is that they will just aggressively expand both horizontally, which we're already seeing, right? They have like this big partnership with this huge comic vendor. So they are tapping into like millions of like comic collectors. So they are also kind of like expanding their asset classes on the platform. But they will also aggressively expand vertically, and they will own the vertical stack. And this will bring them a lot of attention from outside of crypto.
Interesting. That seems to be like the main through line in your current bullish thesis across anything is like, is this project, is this company bringing external attention, external assets?
I mean, we need to start growing the pie again. And the thing is, like, we have like way too many founders, way too many projects, just like focusing on the crypto native bubble. And like all these, I mean, also crypto Twitter is getting like, it feels like more dead than ever before, kind of. And we need to bring new people into the space, and we need like new capital. Like all crypto bros are kind of broke, right? Like they don't have any money left to bid our tokens, and like they don't even believe in kind of like crypto native assets anymore. So like we need this. We got the institutional bit already, but they won't buy our shitcoins. Probably it's getting better with the Clarity Act. But we also need more like non-crypto people again. I think as we are seeing like with TradFi and DeFi, like how these worlds converge already, and we will get to some point where there is no crypto or like non-crypto worlds anymore. They are just like the lines are getting blurry, and those projects who are kind of like moving first to get like these people, I think they will do very, very well. And I think overall, like a big problem is just like the whole token versus equity issue, right? And we need to solve like where you accrue for tokens. And I think Blockworks is doing like a great job there with the token transparency framework and their alliance they just launched yesterday.
Yeah, so you joined that, right? You're part of that alliance?
Yeah, exactly. So we are good friends with Jano. We are also investors in Blockworks. I think you guys are too, right?
Yeah.
So I think like I have massive respect for them because like they're hustling already for like almost a decade, and they're like one of these very few people who actually really care about growing the pie and making the industry heal and who like genuinely care about the industry, right? And not trying to extract like a boatload of money out of it. And I think what they're doing with the token transparency framework, it's very cool, and we see it's working already. I mean, liquid investors like TIA Research or something, they are already publicly stating that they are willing to pay a premium for founders who do like proper investor relations and who do like proper token transparency. And I think we will see this trend continue. And I think like what they are working on is very, very interesting. I mean, it's not very surprising that we see them quite a bit in Washington, D.C. recently.
Yeah, definitely. Simon, hope you survive the next couple months. It's not going to be that bad. I mean, come on, this is a bear market for ants. Just
I think it's fine right now. I think it's the market's doing kind of all right? I mean, your near bags are pumping. My cards bags are pumping. And my hype bags are not pumping.
I mean, you're having a tough time if you're not on the hype near Zcash train right now. I'll tell you that.
Like if you are buying some cards token, I'm going to buy Per.
All right, guys. Well, you heard it here first. Collector Crypt cards. I think like $30 million of revenue. I think some annualized
over 100 million.
Over 100 million. What is that annualized then?
Annualized, yeah.
Wow. 100 million annualized revenue, $40 million market cap. Simon's got vested bags. The FTV on this thing is not very close to the circulating, so watch out for Moonrock. But ladies and gentlemen, he seems bullish, so hopefully he hangs on tight for the ride. Simon, thanks for your time.
Thanks a lot for having me, guys.
Cheers, man.
All right, thanks, Simon.
All right, guys, up next, we've got the Stablewatch team coming in hot. They will get fired up about what they're doing with this Osero product launch.
Oh, yeah.
Purr's ripping. Hype's ready to go back above 60. I cannot believe a member of the Rollup team is trying to get in sub 40 when he knew that the other member of the Rollup team who actually got in sub 40 in the previous run didn't size up enough. Now we got guys like Simon. I'm telling you, Rob, people are so sidelined on Hype still. Like, it's unreal. Simon is like in the trenches and he's sidelined on Hype.
Yeah, I think it caught people by surprise. Look, if you're too zoomed in, sometimes you have this issue where you think these things are too similar. You see,
Purse flying right now, Rob.
You feel vindicated, don't you?
Bro, what are you gonna do if like you get the trade idea right and then like it doesn't even play out in your favor? Buddy, have you ever heard of Bob Diamond? Do you know who Bob Diamond is? Former Barclays
president.
He is the CNBC extraordinaire. That guy will go on and shill anyone.
What's our time horizon on this chart? 5 minutes? 3 minutes?
All right, guys, we've got Piotr of Stablewatch and Osero following their launch that just came out. We got called the Fruit Roll-Up Kids by a Ripple Maxi on Twitter just now. That was Rob's spicy take on Stellar. Stellar wants to come on the show. Hope they don't see that one. And yeah, we got Piotr, founder of Stablewatch. He's going to talk to us about Stablewatch, Osero, today's launch. He's probably sidelined on hype as well. I mean,
what makes you say that?
I mean, everyone's sidelined on hype, huh? What the hell is going on out here?
Yeah, you're making it out that I'm an ETH maxi. Meanwhile, I'm one of the few. I got bags of hype. I'm not in per, but I'm on the hyperliquid train, and it's a stablecoin super cycle. Why don't we get Piotr up here?
Let's get him up.
We've got some things that he wants to share as well.
Piotr.
And Osero is.
Let's give him some love. First time on the show. Second time on the show back. Last time we did that kind of stable coins in review 2026. We'll have to check out the predictions at the end of the year.
Yeah, what's up? Great to be here, guys. Yeah, happy to be here.
Congrats on the launch, man. How's everything looking?
Pretty good. A lot of work, but yeah, it's pretty exciting. So we came out of stealth pretty recently, like 2 weeks, 3 weeks ago. We launched the first product today. In the meantime, yeah, we announced the fundraise as well. Some cool stuff is in the pipeline. So you can hear about that if you're going to be at Stable Summit in New York next week. So yeah, make sure you follow up the updates from our side.
Love it. So you guys raised $13.5 million, $2.5 billion of USDS credit access. Today, you guys had a larger announcement about this yield product. Maybe just kind of walk us through what Osero is, high level, set the foundation for us here and the audience, and then we'll get into some of the data, some of the numbers, and kind of like the USDS Sky bull thesis here.
Yeah, definitely. So Osero is a prime agent within the Sky ecosystem, so you can translate it into sub-DAO, right? Like the Sky lingo is pretty complicated and yeah. So let's talk about it as a sub-DAO pretty much. There's only few whitelisted parties to take care of, like, let's say, economic activity for the Sky protocol. So Sky protocol itself as decentralized set of smart contracts and is setting up the incentives, constraints, how the ecosystem should look like. But then us, so those prime agents, sub-DAOs, are doing the big part of the work, meaning helping manage part of the balance sheet. So in our scenario, this is up to 2.5 bill capacity to allocate into different kind of stuff. What we looking at Osero is mostly potential allocations on the RWA side. So we're looking to quite few sectors which are uncorrelated to what is currently on the Sky's balance sheet. And then very big focus of what we do in at Osero is the expansion of the Sky ecosystem. And because of that, we've built Osero Earn. This is the simplest way to integrate SUSDS, so the biggest yield-bearing product to put your stablecoins to work and get yield, 10 lines of code. So within, let's say, 1 hour, you can get that whenever you're on exchange, custodian, neobank, or maybe a wallet. And this way, yeah, you can offer that best risk-adjusted yield in the whole space to your users. Beside that, our app also going to be live in sometime relatively soon, and we're working on all of the technical as well as the like risk and legal setup to start going on with the allocations.
Love it. So I actually talked to Kyle from Milk Road yesterday. He came in the studio. He gave a bearish Zcast take that was blowing up. People call him a retard. And then he also gave a take about the Sky revenue versus hype revenue, why these things aren't valued in the same way was also interesting. But one of the things that he said in that response about Sky versus hype and how the PDE ratios of these two assets are far different, and there's like a big kind of gap in the way that the market is valuing Sky versus Hype, is that Sky wants to be the safest place, and their whole brand is predicated on being the safest possible place for yield for stable coins on chain. Like that's all they care about. How does Osero kind of take that similar mindset and approach to how you guys allocate this capital and what you guys are doing? I know it's not sexy. I know it's not hype. I know it's not like something that's gonna, 100x. How do you guys maintain security, safety? Is that one of your top priorities?
Yeah, definitely. This is like the most important thing on our plate, right? So we want to help manage risk and streamline this in a great way, because you can't eliminate risk ever, right? You're always gonna be exposed to that. If there's any yield, definitely there is some risk, but the goal of Sky ecosystem is to manage that in a proper way, right? So you can see that, all right, like at the moment, Sky savings rate is around SOFR, right? So you get paid pretty much similar rate to overnight rate in the banks in the US, and that is not sexy, as you said, but this is the biggest yield bearing stablecoin, like yield bearing asset in the space. So even while it's not sexy, you could say, it's still a lot of demand for it, and the supply is only increasing all the time. When we speak with potential integrations, for example, around the Osero SDK, yeah, we see a lot of demand for that product. And why is that? Is that I believe that if you're holding like bigger amount of capital, you of course don't want to be exposed to too much risk, right? Your main objective is to defend your capital, grow it, but yeah, most importantly, you don't want to lose it. And in recent months, we've seen quite a lot of bad events for the whole space. So starting with the stream blow off and so on. So around that, yeah, you got the vault curators. So they behave also kind of like a money manager for you. You could say like it's actually like a hedge fund you allocate into this vault. They make it money in a different ways, like different kind of strategies. A lot of that been based on working around stream finance. But in most of the examples, unfortunately, they bear no risk. So there's no liability on the curator side. We got like few really great firms which are doing great, right? We got Steakhouse, we got Gauntlet, which are doing really great work, some smaller ones as well. But still, unfortunately, this space is not really safe. When you enter in this kind of a vault, you could have some juicy API. It can be, I don't know, 5-10%. You can find different vaults, but in the end, if something gonna happen with your money, there's you're just left on ice, and there's no any capital buffer, any legal liability they take it on, and so on, right? So it's pretty much a lot of risk. You're underwriting for maybe 3, 4, maybe 5 more percentage points on your capital. So if you're allocating 100 mil or maybe more, I don't think so. This is kind of risk you would like to take. Then the other kind of opportunity where a lot of people are putting their own money is to lending markets, right? And when we're speaking about them, the problem is that in most of the cases for the big lending markets, you pretty much like funding looping of two assets, ETH and SUSD, right? And derivatives around that, especially around ETH. So there's actually pretty big concentration risk around where this yield is coming from, and then if something gonna happen in one of those two positions, those two strategies, you're in very bad spot. And we've seen that very recently, which happened, you could say, not because of the not because of the like platforms like this are structured, but because of the Kelp DAO hack. But still, the depositors in those markets being very much exposed, then the rest of the people also couldn't withdraw from the markets, and so on. So once again, the risk is pretty pretty concentrated in one place, and more people are getting like sophisticated around how they want to manage risk, and Sky ecosystem is providing like really the best way to do that and get the safest possible exposure if you want to allocate your money on chain. So how
gold standard. The gold
yeah,
standard.
yeah, pretty much. I would say so. So how the whole system works is the risk framework is based on the Basel III. So this is banking regulation introduced after 2008, after the banking crisis, and how it operates is that if there's any position on the balance sheet and you would like to borrow. As a like regional bank or whatever, like in this scenario, let's say to make it easier, that Sky is kind of a DeFi central bank, and us, the primes, are operating like around it and got those master accounts. So then Osero, if we would like to allocate in any kind of opportunity, we need to post our own risk capital, and only then we can borrow money from Sky. And to very much simplify how this works, let's say that we're taking very long time frame, let's say even up to 20 years for some asset, if that would be like some RWA asset, and we look for the biggest stress periods, what's been the drawdown, of the NAV and during, let's say, COVID crisis or maybe 2008 crash and so on. Let's say in some scenario that would be 8% drawdown. And once again, this is simplified, but then the risk ratio would be 2x of that, let's say maybe 16%. And then if we put 16 mil of our own capital, we would be able to borrow 100 mil from the Sky and then allocate into that. We pay the borrow rate. This is how the yield for SUSDS is generated. But then if something gonna happen to that position, we need to manage different kind of risk, like time to liquidity. All of those positions need to be like really liquid. We need to be able to liquidate them very fast if there would be any withdrawals and to meet them, or if something would be happening to the asset, like the price of it would be going down. And in this scenario, when the price of this asset would be going down, Sky, like us, would liquidate that position, and we, as a prime agent, as Osera, would need to plug that hole with our own capital. So that means that the Osera incentive is totally different than incentive of like a risk curator in some kind of a vault, because we need to have skin in the game in any kind of opportunity.
And Piotr, I just want to pull up on the screen a diagram to kind of help the audience understand a bit how this works a bit better. Let's get that up on the screen, and you can kind of, you can see the Sky ecosystem, the Osera earned here up on the screen, and you kind of just explained how you guys have to put your own capital up in order to have an opportunity to get capital from basically the USDS in reserves in Sky as a prime agent. And then this kind of diagram walks through how this kind of plays out in a distributor method. So maybe you could just walk us through this diagram as you just did, short and sweet, on what is happening here with Osera Earn.
Sure. So this chart is actually about Osera Earn SDK. So this is how, like, from the tech standpoint, as a integrator, so it can be wallet, neobank, or whoever like integrates SUSDS, and how we through our SDK just helps you handle everything, so you just don't need to care about that. So this is totally different topic actually than the risk framework, which I've been talking about. But yeah, so like very simply, if we want to stay on the like with the risk topic, let's say we're looking at position A, which seems is extremely vanilla. This is something like maybe money market funds or whatever, something which is bearing very low risk. We need to assess a few vectors when it comes to the risk side. From our side, that's going to be all of the economic risk and so on, but some other teams are also working from the tech assessment. There also need to be a legal assessment in place. But from our side, let's say that this is a very vanilla opportunity, and the risk ratio, which is described as CRR in this Basel III based model, so required risk capital, the the risk is calculated in a percentage number, and in this scenario that would be 5%, let's say, right? So if we post 5 million of our own capital, then we'll be able to borrow from this guy's balance sheet the 95 mil. Altogether, 100 mil is getting to the opportunity. And once again, if something is happening with the position, it's getting liquidated, and the whole after any potential loss would be plugged by our capital, not Sky Capital, and so on. And very important is that we as Osero got our own junior risk capital in place, but within this Sky ecosystem, we also got our own underwriter, which holds, you could say, mezzanine capital. So if we would default, then there's another extra layer of capital, which would be defending users. So there's no haircut on the price of USDS. And even if that capital would go to zero, then there is still surplus buffer, which you could say it's senior tranche, which is at the Sky protocol level. So actually there's very clean, very easy to understand waterfall of losses if you're looking at the Sky protocol. And what is said is that in most of the other places where you can generate yield, it's not that easy to understand how this would look like, or that you're actually directly exposed to risk. If something gonna happen, you're just gonna take this haircut as a user.
And Piotr, could you describe kind of the flip side of this? You mentioned, we've been talking about risk quite a bit, but talk to us more about the demand side. Like, at the top of this, we have distributor platforms, right? Wallets, neobanks, exchanges, custodians. Can you just unpack who you foresee? Maybe you guys already have several of these teams integrated. What is the plan to go out and get some more demand, get some more distribution to ultimately grow the USDS supply and deposits into Osero?
Sure. Very good question. So, like our thesis is like from the beginning, so also from when we started working on Stablewatch, that stable coins are already eating the world, right? You can see that on the payment side, a lot of like TradFi venues, fintech venues as well, like this first generation of fintechs, they're moving faster and faster to on-chain rails when it comes to payments. But what is not really being worked on yet, and we're working on that with Osero Aaron, is how this transition also gonna look for the yield products. So if you're gonna look at what saving accounts in US are yielding at the moment, like the national average is like around 0.6% APY, right? Very low. And users really want to get somewhere else with their capital because it's like Fed and some other agencies and governmental bodies are predicting the inflation like mid-term gonna be probably about 4%, even close to 5%. So then if you're having your money in the like plain bank account, this is like pure loss, right? You're just losing money all the time, and your portfolio is bleeding. And banks really won't be able to offer better yields in upcoming year, 2, or maybe 3, because most of those customer deposits are actually also with regional banks, and they put a lot of money into like CRE bonds, like commercial real estate, in like around 2020. Rates were super low, like around 1.5, maybe 2, but most importantly, the prices of those commercial real estate really went down. So they are sitting on big losses, which are not yet, visible on their balance sheet because those loans haven't matured. But they're gonna mature. There's like very big wall. I think 400 bill gonna be maturing just this year, so it's like really huge amount, right? And then banks, to still be operating, especially those smaller banks which are holding those assets, they need to build like healthier, bigger balance sheets. They're also regulated in like under Basel III or like similar framework, so they need to hold a lot of like plain cash, right? to meet the withdrawals. And when they're gonna show those losses, they're gonna be undercapitalized, and that means they just need to make more money. And that's why last year and this year the profits of the bank, like net margins, are highest from I think 2019 at 3.3%, and they just can't pass this yield to users. And that means that like very big opening for anybody really working on this yield side and providing users with a safe, reliable way, transparent way to earn on their USD deposits, or in our example, stablecoin deposits, right? If you look at the fintechs, they already go into that direction, trying to capitalize. Like Gold's cash sweep account at Robinhood is paying 3.3%, I think, and still SUSDS and Sky is beating that. So if you compare SUSDS, like the biggest yield product on chain, the safest one, the most transparent, the best liquidity profile as well, more than 5 bill sitting in USDC idle, so you can swap it any moment 1-to-1. With USDS, this is actually very attractive if you compare that to what you could get in a normal savings account in the bank, but also most of the fintechs. So this is the best moment really to try to capitalize on this opportunity. That's one thing. The other leg of that is that most of those yield opportunities beside lending platforms are sitting around USDC. And we know that like swapping one USDC to one USDT, it's not always that easy. This is something we also try to work on at Diosero to minimize this friction, because some other like really high potential opportunity lies in emerging markets. A lot of people, they're already using different kind of neo-banking platforms. A lot of them are built from scratch on the on-chain rails, right? Like Yellow Card, for example, in Africa, and so on. Those people are using USDT mostly to transact, and very often they don't have any opportunity to put that USDT to work in a very easy, very transparent, very safe way, and not take, a small loss because of the conversion, because of the swap from USDT to USDC. And in those emerging economies, people maybe want to invest, I don't know, maybe even $10 a month. And if they would need to pay like 20 cents or like 30 cents for this swap, it's actually, very meaningful to them. So minimizing this friction is also very important. And this is what we're working on at Osero.
Love it. And I mean, I think part of the appeal for Sky is going to be as the kind of supply of USDS continues to grow. Like we can pull that chart up on the screen. You can see that it's just been very, very, very steady in terms of the USDS growth. The appeal here is that as USDS grows, there becomes more demand to deposit into the protocol for the Sky asset for protocols like Osero. I'm gonna get that chart up here, Leo, on the screen, and then we'll kind of talk about it and how Piotr, you're seeing Osero contribute to the SUSDS growth and the USDS growth at large. What is the plan for Osero to really go out there and contribute to scaling the outstanding supply of SUSDS and USDS?
Sure. So I think that like Osero is playing like a really crucial role in all of that, as the like only prime agent, only subDAO we're that focused on those integrations. So we already got a lot of ongoing conversations. In upcoming weeks, you'll be able to see SUSDS in your favorite apps. I hope so. So it's like very big focus from our side. Beside this, as I said, like very big problem is that USDC is the main asset you at the moment can swap into USDS or SUSDS. So eliminating this friction around USDT also gonna open very big market for us. And yeah, Osero is already working on this. Also, like the third angle to that is that we're very much focused not only on accommodating the existing market. So most of the teams, also if you think of neobanks or so, they're actually targeting the Western world user who got the access to like maybe US banking accounts or maybe European ones using Revolut. And as I said, this is great opportunity because still we can just provide better yields and really be competitive to what is offered in TradFi and fintechs. But in our scenario, we also try to expand more, especially in APAC and South America at the moment. So we have a lot of conversations going on there, and I believe like long term, this is very big unlock and pretty much aligned with what US, I assume, would like to achieve with stablecoins. US needs to export the debt somewhere. So the more of a stablecoin usage in emerging economies, the happier US is, I would say. And then the genius is banning like direct yield pass-through from like big players, issuers like Circle or Tether. So this option like SUSDS to turn your payment stablecoin into yield-bearing asset is very it's amazing opportunity for people in those places.
Got it.
Yep. And this is something that we anticipate continuing to grow, especially in emerging markets, as you're saying, and as well in the US and more regulated markets as well. As regulation continues to advance, we get the Genius Act put into place, we get the Clarity Act, payment coins will transition into interest-bearing stable coins, and that could be an exponential catalyst for the growth of USDS.
Yeah, totally agree on that. So we're already on a great trajectory, right? It's already the biggest asset this kind on chain, and I think that we're going like much higher in the coming months. We see a lot of demand coming from different places, and at the moment we also working at Sky on a lot of initiatives which gonna help us scale even faster. So better data infrastructure, better tech infrastructure when it comes to smart contracts and so on. So all of the work is just more smooth, and that means that the time to any integration and so on gonna be getting shorter, and we're gonna be capturing the market faster. Osero, Aaron, our SDK is like part of that and is letting you integrate within our you could do that even faster. It's literally 10 lines of code. So that's a big upgrade.
Piotr, thank you for spending some time with us. Congrats on Osero Earn, savings for wallets, neobanks, exchanges, pushing forward Sky, USDS. Obviously, we're big fans here of Sky, of Osero, and what you guys are building. So again, congrats for pushing the needle. I know this has been a long time coming for you guys. Looking forward to hanging out in Europe. Hope you have a Europe summer, and we'll see you soon, all right?
Yeah, definitely. See you in New York sometime soon as well. Thank you very much,
man.
guys.
Come over in June or July. We'll be around.
Awesome. Thank you.
Thanks, Piotr.
All right, buddy. All right, guys. Up next, we've got Joe Chalom answering the question that all of the ETH haters want him to know: is ETH dead? No, I'm just kidding.
That's what we're gonna find out. I mean, look, Joe's always a very thoughtful guest on the show.
Yeah,
I've had the pleasure of chatting with him several times, as well as his Joseph counterpart, Joe Lubin. And so I'm excited to chat with Mr. Chalom today about ETH. Obviously, so many changes happening in the ETH ecosystem. I think we just need to cut through the noise a little bit. It's tough out there. So many opinions around Ethereum.
There's a lot of opinions. There's a lot of opinions about the market in general right now. There's a lot of people who are, kind of jaded right now. But Joe and SharpLink have just struck a new deal with Galaxy for a SharpLink on-chain fund. Also, SBET will be joining, it will be joining the Russell 2000, 3000 sometime in end of June. Clarity Act, 873,000 ETH. There's a lot to cover with Joe. We're going to bring him up, cover it. We're going to see if he's going to add hype to the balance sheet. I don't know if he's ever going to do that, but I'm quite tempted to ask him. Quite tempted to ask him.
That's a good question. Yeah, why don't we get him up here and we get going?
Yeah, man. I mean, this should be fun. Joe's obviously close by in New York. Looks the part. Looks ready to go. He's always a fun time. So
one of the, just while we're bringing Joseph Chalom up, one of the takes around ETH that I've heard that has just I've just been thinking about a little bit more is this, we used to have Bitcoin, not blockchain, or blockchain, not Bitcoin back in 2018. There was this big institutional blockchain push. We're going to put all of these assets on chain. This is a new financial rails. Everything's going to end up on blockchain. But Bitcoin is sort of, it's used for drug dealers and crime and these sorts of things. So big blockchain, not Bitcoin push. And now we're seeing similar rhetoric with ETH, right? Tokenize the world, put all the assets on chain, put them all on Ethereum.
100% agree with that.
But
100% agree with that.
The asset is maybe struggling to find value accrual. So I'm interested in asking Joseph Chalom this, as well as getting broad takes on Ethereum. Why don't we go ahead? I think we've got him ready. Let's go ahead and bring him up and welcome him to the show.
Yes, sir. Yeah, well, I mean, if you look at crypto Twitter, people will tell you that Ethereum is dead, but then you look at Mr. Chalom here and look at him. He's got a nice haircut and a nice suit. I think ETH is anything but dead here. Joe, welcome back to the show, man.
Great to see you both. And by the way, two guys from Florida, there's nothing better.
Love that, man.
Got it right. That's absolutely right.
Well, as I said, Joe, I mean, there's a lot to talk about. You guys have been doing some great work. We got to address the elephant in the room. If you look on crypto Twitter, if you look at people that have been ETH fanatics, you have the bankless guys breaking up and one guy selling all the ETH. You got people claiming that it's the easiest short ever, dunking on everyone. I mean, Rob was just kind of giving this analogy to 2018, the first bear market that we went through, where it was blockchain, not Bitcoin. Bitcoin had fallen and gotten crushed. Everyone was bullish on the promise of blockchain, but had these really negative, jaded takes about Bitcoin. Everyone right now is very, very bullish tokenization and stablecoins, but still seems to have these negative, jaded takes on ETH, the asset. Let's set the stage for the conversation. Joseph Chalom, is ETH dead?
No, it's not dead. I think when people capitulate is the time that smart money is made. And can I take a step back? So SharpLink is the second largest corporate holder of ETH. And I think we just need to tell that to your viewers. I have a stake in the outcome here. Other than Tom Lee, we are the second largest holder of ETH. And let me just give you my perspective. And this is one human's perspective. I'm not looking for crypto Twitter to blow up and create hate here. The noise is missing the big picture. Let's step back from the short-term drama around the Ethereum Foundation, and why don't we actually be objective and look at what Ethereum has delivered and how it's positioned. Let me start by saying, you guys came from a sports school. Look at the scoreboard. So in the properties that matter most for institutional adoption, which is the future of Ethereum, Ethereum has the most trust, liquidity, and security, objectively speaking. It has the license to win. But sometimes in life, you have the license to win, but you're not winning. In all the categories where that license converts into real economic activity, Ethereum isn't just winning, it's winning by a large margin. 50+% of stablecoin value globally settled on Ethereum. Tokenized assets, as soon as some of the next projects are tokenized that have been announced, it'll have 70% of all tokenized assets in the Ethereum ecosystem. And it frankly is the default for high value DeFi transactions. So there is no competing chain that's close on any of the dimensions. So I want to start with a reality check, look at the scoreboard. And these did not happen by accident. And I'd love to have a really heated conversation, and I'll give you my hot take on what's going well and what's not. But the scoreboard says Ethereum is winning, and it has a license to win.
Yep. And we want to get into some of these hot takes as well, but we also want to talk about the facts. And the fact is that Ethereum is winning when it comes to stable coins. You mentioned over half market share when it comes to all the stable coins. It's winning when it comes to tokenization and RWAs. Significant amounts of RWAs are on Ethereum. But let's get into some of the spicy stuff, Mr. Chalom. I mean, the asset is just not reacting to the lead that Ethereum has in some of these very significant categories, despite the stablecoin supercycle, despite the importance of tokenization broadly for finance as a whole. With all of this happening, it seems that the asset would be accruing a lot of value. People have been saying that something when it comes to the value accrual mechanics is broken. I'm sure you can tell us and help us figure out and separate facts from fiction here. When it comes to ETH, the asset, what are people not understanding?
I think people don't understand that we're at a step function moment. And I'm not talking about Ethereum continuing to own 70% of all tokenization. I'm suggesting that right now, there's only about $32 billion of tokenized assets in the world. You're going to start seeing that go up by 5x, 10x, maybe even 100x. And when that happens, you want to be on a chain that's actually been building for that moment. And I have a great analogy for you. People really, really gave Jeff Bezos a hard time as he was building his book-selling business. It was losing money. It was losing money for years. And they basically said, look at the price, don't look at the activity. And he would say very clearly, I'm not selling books. I'm changing and building a platform that's going to change the future of commerce. And you need to be patient with me because the TAM is going to be huge. And it turns out from those days, Amazon's price 1,000x'd. So I think we need to take a step back and say, Ethereum actually has been doing the right things. The foundation is trying to become even more decentralized. And by the way, that is not a bug. That is a feature. Look at what they've delivered over the years. And if I had a trade-off, and we'll get to the price of ETH in a minute, if I had a trade-off of having a chain that is amazing at short-term marketing and selling and conferences versus a chain that's built 10 years of security, throughput, privacy is coming, and quantum proofing, and you're taking a long view, I would take the chain that's decentralized and is building the platform of the future over a short-term marketing engine. And I'm not trying to FUD anyone. I have a lot of respect for the other chains out there, but I'd rather bet on the one that's building for the future because the value to Ether will accrue when you see these step function changes coming to the ecosystem. So like, I'm not in a defensive position. The debate we should have is what is the role of the Ethereum Foundation versus the role of the private sector in the go-to-market and the marketing around the Ethereum institutional adoption. It is clear to me that the EF is not interested in being the go-to-market and marketing arm. They're interested in building security, trust, throughput, and quantum proof, which I would take if I had a choice in a minute. But it means that people are going to need to step up, and I'm being very, very direct here.
Yeah, and I think you bring up the most important point, I think, just to start off, which is absolutely great, which is, we want to know your view then, right? People have alluded to the likes of Tom Lee, the likes of you and others kind of stepping up and being that BD arm, that institutional sales arm with what Etherealize is doing as well. How do you view the role separation now of the EF and the Ethereum Foundation, what their role is versus what all of the treasury companies, all of the private sector companies doing investments into Ethereum or into the ecosystem like SharpLink are? In your mind, what is that role distinction? Because I think right now the community wants to have a clear distinction and they want to stick with it and they want to know kind of what's happening on both sides. What do you view as that clear role distinction as it stands today?
Well, I think it's very clear that Vitalik, who's a visionary, is thinking in decade-long periods, and he's trying to future-proof Ethereum as the decentralized, uncensorable platform for the future, not just for finance, but for governance and AI and other things. So the role of the EF is to become the builder, the standard bearers, but also, when necessary, they will take teams that are in the EF and decentralize them. And there's a method to this, and I'm not even going to use the word madness. There's a method to this, which is they want this chain to be survivable in any situation. And by decentralizing validators, decentralizing node operators, decentralizing the core protocol builders, it's not tied to any one person or the size of the treasury. So that's number one. Number two is I would say there are a lot of voices from Tom Lee to Etherealize to myself to Joe Lubin, who feel like we've been the ones telling the institutional story to the institutions. And by that, I mean sharing facts. The most secure platform has never gone down for an instant. When other chains have beautiful websites sharing their downtime, Ethereum doesn't need that. But the most important thing that we do is when we talk to institutions, and we do that regularly, we explain to them the benefits of having a platform that's truly decentralized, where you don't have an individual player with governance rights who might have a lot of money in their treasury, but can actually change the rules of the game. If you're building the future rails for the largest banks, asset managers, insurance companies, clearinghouses, they want certainty that no one is going to change the rules of the game. So I think the role of the private sector, ETH holders like ourselves, is to tell that story. I also think you'll see over the coming weeks and months, groups coming together in more formal ways to tell the story. And I do think it's clear that it's not the role of the Ethereum Foundation in its future incarnation to be the marketing arm of institutional adoption. That has to happen from the private sector, and you'll see the largest stakeholders step up. It is our responsibility, period.
Yeah, and we're all incentivized to do so. Joseph, I'd like to switch gears for educational purposes for just a moment. Given your background, serving as managing director at BlackRock, head of strategic ecosystem partnerships, you played a key role in shaping some of these digital asset products, like some of these, iShares Bitcoin Trust, as well as the iShares Ethereum Trust. Recently, we've seen quite a bit of activity in these ETFs, both in Bitcoin and IBIT, as well as the ETH ETFs. These things have had record numbers of outflows. The market has absorbed those outflows relatively well, but could you help us understand what this activity could mean, what these flows could mean? Is this capitulation, these massive block trades, essentially shaking these teams out, selling is becoming less and less significant? What do you make of the recent activity, given your deep understanding of these ETF products?
Sure. Whether you're talking about the ETFs or the DATs, they're largely beta exposure to the underlying asset. And their job is not to make the price of Bitcoin and ETH go up. The job is to create a great product. The ETFs are great products. The DATs are great products, to give people a better exposure vehicle than owning spot yourself. You don't want to own spot Ethereum, Ether, and then try to stake it if you're an institution. So these vehicles are meant to allow people to express their opinions. And let's just be clear, in crypto, which is different than traditional finance, people in crypto buy when the price is going up. In every other market, people step in and buy when the price is going down, but they're functioning exactly as they should. Neither BlackRock or Fidelity or Franklin Templeton, it's not their job to create demand for Bitcoin and ETH. It's their job to give them a better wrapper. And these ETFs are functioning exactly as they should. And the markets will tell the story. Is there interest or is there not in each one of these underlying? But I will tell you, it feels like at this moment, when people capitulate in retail markets and the sentiment is low, that is exactly the time to buy. That's when Warren Buffett buys. That's when money is made. I'm old enough to know that when sentiment was bad in the 1970s, they bought Geico. When sentiment was bad around Bank of America and Goldman Sachs in 2008, Warren Buffett bought those. And you make money when others capitulate. You just need to be mid to long-term oriented. So the final thing I'll say is, and I don't work at BlackRock, I don't speak at BlackRock, I worked there for 20 years. When FTX came about, most institutions stopped talking about Bitcoin and ETH. They weren't launching funds. At BlackRock, we doubled down during that winter, and it turned out that was the right move. So I think sentiment can be counter-cyclical. I'd be very bullish right now on the risk-reward at these prices.
Yeah, but I think, just to add to that, like the sentiment side is there because of the underperformance of ETH, the asset, for the last couple of years. How do we turn this thing around? This community is one of the best in all of the industry. What are you seeing for ETH, the asset, right now, as far as kind of turning around the underperformance and turning around the ship here. It seems like we're probably coming to like a accumulation phase across the markets at large. Bitcoin's kind of just been chopping around the last, I don't know, 5 months, 4 months. I'm not looking for like price predictions or like up or down here, but like holistically, macro wise, underperformance for a couple of years. People want to turn this thing around. Sentiment is bad because of that. I understand the counter-cyclical nature of sentiment and kind of trading against your own psychology or the crowd. But what is going to turn this thing around?
I think it's going to be three things, and I'm not going to give a price prediction other than what I said, which is the risk reward right now looks really good. But there is a complete divergence between the price of Ether and what you're seeing in the market. I think it's attributable to three things. But you're right, it's not a short-term thing. It's been persisting for a bit. One is just, we are in a risk-off environment, and for most of its history, Bitcoin and ETH generally traded uncorrelated to stocks and bonds. What we've seen in the last year and a half is actually a very high correlation between Bitcoin and ETH to high-risk equities. And what's interesting is you would argue that the markets are up, but in reality, a very small corner of the financial markets is doing remarkably well. It's the AI stocks and anyone providing inputs to that, the memory, the chip businesses, until such time as there's a broader market sentiment that's risk on. I think crypto assets are going to lag, and I'm being very direct. And the second thing is the geopolitical risk and the lack of liquidity in the market go hand in hand. With inflated oil prices, look at the price of WTI crude. It is probably the greatest indicator right now on the price of Bitcoin and ETH. You look at the price of WTI when it goes up, Bitcoin and ETH are inversely correlated. You need the war to end and the price of energy to come down. And the final thing, I'll just be very direct, is we expected at the beginning of the year 3 rate cuts, 75 basis points. And Bitcoin and ETH are incredibly sensitive to rates and liquidity in the market. And until such time that you get this temporary oil-driven surge of inflation out of the way, it's very hard to imagine the Federal Reserve cutting rates. So I think you need more stability in the geopolitics. You need a broader market recovery with a broader risk on, and you need rate sentiment to be more dovish than what it is today. Until then, I think these are going to be trading sideways. But again, this is probably one of the best entry points as we've seen. It's very hard to explain when tokenization, stablecoins, DeFi, and agentic are coming. And every day there's another announcement from an institution that 2 years ago would have moved the price of ETH. I think there is so much positivity before you even talk about the Clarity Act. We just need the decks to clear out a little bit to let it run. But I'm not in the business of making price predictions. Sorry about that.
I love it.
And so Joseph, I think we all agree and we see the potential in the Ethereum ecosystem in leading these categories: tokenization, RWAs, stablecoins. I think this inevitably leads to the rise of activity on the Ethereum blockchain. But there is this cohort of people out there where it's like Ethereum, not ETH. Right, just like it was blockchain, not Bitcoin in 2018. Obviously, we know how that played out in 2018. Bitcoin ran to 100,000 plus. Again, not asking for price predictions. There are people that say that there's something wrong with the ETH value mechanism. Right, is the thesis here that we increase the transactions and the activity on the Ethereum blockchain to such an extent that the burn is triggered and the ETH monetary mechanism kicks in. This ultimately, is going to reduce the supply. Demand is going to increase. We know what happens. Or is the ETH is money thesis? Is that still the driving thesis here? What is the thesis for ETH, the asset, and why is Ethereum not ETH? Why is that the incorrect take here?
Yeah, I think it's the former, which is, let's just be clear. When you see what the Ethereum Foundation is building, and I'm talking about Ethereum mainnet right now, I'm not talking about the L2s who are built on top of Ethereum. They're basically reducing gas fees significantly. They're doing 3x increases in capabilities and throughput, because mainnet needs to be built to support the volume that's coming from tokenization, stablecoins, and agentic micropayments. I think if it grows incrementally, you won't trigger the burn in a way that's going to drive the price of Ether up. But we genuinely believe we're going to see step function increases from stablecoins, tokenization, and agentic that will create that demand that will trigger the burn. And when that happens, and you start seeing 10x, 20x, 50x or more transactions on Ethereum and the L2s, you're going to end up needing Ether as that trustware to secure the transactions. That is the thesis. But I gave the Jeff Bezos analogy, which was he was criticized for selling books at a low cost, driving throughput and volume. I would make an argument taking losses for a long period because he was trying to build for the future of e-commerce. And then you saw what happened. I believe the Ethereum thesis is very similar. So I don't think it's the Bitcoin store of value. I think the network is going to end up having transaction volumes that are going to be so high that you'll trigger the burn, and that will lead to higher Ether prices. That would be the conviction I have.
You know, I agree with you because I think we are able to reach these levels of scale, but I have this internal Jevons paradox. And it's that, you know, the EF and the developers and all of this work with really, really intelligent developers is going into scaling the chain, which is driving gas fees lower on a per transaction basis. On the other side, you have greater activity. But it feels like these things are at odds with one another. If we're really going to scale the chain, we're going to make transactions very, very cheap, then we wouldn't create as much congestion on the network, and therefore we wouldn't require as much fees in order to charge on a per transaction basis. Again, this might just be compensated by the enormous amount of scale of this activity. Is that the case? We're just going to outpay, as intelligent these developers are, as much as they can reduce the fee overhead and scale the chain. That is just nominal when it's relative to the amount of demand that we're looking to create here with this activity.
That is the answer, and that is the belief. And they're trying to be prescient, which is and when you see what's coming out in Glamsterdam, it's going to be able to handle volumes like we haven't seen, but also be able to handle periods of low volume and handle periods of peak volume because the system can't fail over. And I think you're going to end up seeing that. And I think it's some combination of stablecoin growth, but I think tokenization people are wildly underestimating. And when that happens and you start seeing 24/7 trading on NASDAQ and NYSE, and you see the DTCC leveraging a series of change to dematerialize collateral and allow wallet movements. You would have seen the Brian Armstrong tweet a few weeks back saying there were 160 million agent-to-agent payments in Q1, very small dollar amounts, but this is the tip of the iceberg. And when that demand comes, you're going to need Ether, the token, and there's going to be a lot more burn, and that should be really positive for Ether. But they're not taking short-term decisions, and I think it's actually very smart. How this is all being communicated, I don't think is great. And I think, as I said earlier, private sector stakeholders need to have a much bigger voice in terms of organizing that thesis and how we tell the story better. It's a marketing problem. It's not a protocol problem.
And I've got one quick follow-up on this note, because it does seem like tokenization, Ethereum is the leader, stablecoins as well. But on tokenization, there's kind of the spectrum of assets that are ready to be tokenized. Andy and I have talked about this before. It's part of our neo-finance thesis. We started with stablecoins, the lowest on the risk curve, and now we're getting into, bonds, private credit, tokenized equities. We're kind of going down the risk curve when it comes to the tokenization thesis. All of these things become tokenized and become on-chain, and a large swath of those assets end up on Ethereum. The question I have is how much velocity do we need? Really, like the strength of Ethereum seems to be the security of it. It never goes down. It's very secure. It has very robust and resilient infrastructure. But when it comes to the amount of throughput or high frequency activity that we need in order to really, really ramp up the number of transactions per second, it feels like a lot of that activity has flowed to the likes of Hyperliquid and Solana, whereas, they might be prioritizing speed, Ethereum is prioritizing security. How much of the tokenized assets that are coming on chain are coming to Ethereum for a lot of transactions per second, and then therefore, playing into this, very high activity thesis that ultimately, we talked about is flowing into ETH, the asset?
Yeah, I'll answer that in two ways. And again, I want to be the most positive person in this ecosystem. I believe there are going to be a lot of survivors. Solana is doing a remarkable job focused on like a very narrow use case of high frequency trading. I think if you look at where the real money is, look at the largest asset managers in the world, the Vanguards, the JP Morgans, the BlackRocks, the Franklin Templetons. The amount of assets that they're going to be tokenizing and the transactions they're doing is not high frequency, but when they're on tokenized rails, just take a step back. We've been talking about tokenization since 2017. There are $32 billion of assets tokenized roughly. BlackRock announced that they're not going to tokenize a new fund. They're going to tokenize an existing fund with $7 to $8 billion in AUM. Wait till you start seeing the next one, which could be a large asset manager tokenizing an S&P 500 fund, which could have $500 billion in that fund. So you're talking about step function increases coming. I don't think it's going to be the high velocity, high frequency, black box algorithmic trading. I just think you're going to see most transactions over time in ETFs, in individual stocks, in the most liquid corporate bonds are going to be traded on chain. And I don't necessarily think it's because it's 24/7 versus, 9 hours a day. It's just going to be a lot more activity on chain that exists today. And I think what we miss is one of the biggest chicken and egg problems in tokenization is you have these products, but they're KYC'd and it requires liquidity. And until you start seeing bigger and bigger funds and bigger participants coming in, you're not going to have the liquidity profile to allow that high velocity. But at some point, you're going to get to a tipping point, and liquidity begets a liquidity. I think it's going to be coming from the buy and hold type investors who happen to manage hundreds of trillions of dollars. It's not going to be the high frequency traders who are really focused on that one Solana speed use case. These people need finality over speed, and they need economic security over speed, and they even need economic security over price. So I don't think it's going to be the high frequency. It's just going to be there's the volume of tokenized assets, and the time periods they're going to be able to trade in is going to be 10x, 100x, 1000x what you see today in terms of tokenized assets trading. We're at the tip of the iceberg. We're in the top of the first inning, not the middle innings here.
Yeah, I mean, we've been just trying to shatter this reality in people's minds that we've built this on-chain ecosystem for the $150 billion that's on-chain and the 3 trillion total assets in the cryptoverse, and that we're really looking at the hundreds of trillions of other assets being tokenized, being used on-chain. Those will be on Ethereum. One of the things, Joe, that I think is exciting for people is this idea that eventually the major crypto assets will have this kind of passive bid. And it's starting with MicroStrategy, eventually getting into the S&P 500. And on the SBET side, it's getting into the Russell 2000 and 3000 later in June. How should we think about SBET's entrance into the small cap indexes as a way for ETH, the asset, or SBET to have this kind of like passive bid from pensions, from middle-aged people using a financial advisor? Talk to us about kind of like the evolution of ETH getting a passive bid from institutional allocators who serve the average mom and pop, and how ETH will kind of be part of their portfolio, whether they know it or not, as a result of some of these major indexes accepting a equity like SBET.
Yeah, so let me take a step back for your viewers. There were 6 or 7 Ethereum DATs that launched last summer. There were 2 of us who were able to successfully raise billions of dollars. We raised $3 billion. Tom Lee has raised much more. And we both have something quite unique, is we have volume, in our case on the NASDAQ, in their case on the New York Stock Exchange. Being included in an index is really important. So for example, the Russell 2000 and 3000 indices, there are two ways that this is going to benefit the companies included, including SharpLink. The first is, as you said, people are managing, I think, over $150 billion from an index perspective on these two indices, where you essentially, if you're an asset manager and you have this product, you need to have every constituent in every weight to own that index. So I don't really call that passive investing. You're still exposing yourself to mid caps and extended cap stocks, but that is what you call passive flows, because if you're into index like we will be at the end of June, it's necessary when you buy the index, you buy SharpLink. The second thing that's not talked about, and maybe it's because I'm a boring TradFi guy, is many investors who are buying equities, many asset managers are only allowed to buy those that are included in the index. Meaning, if you're not included in the S&P 500 or you're not included in the Russell 2000 or 3000, even if you're an active manager trying to outperform a benchmark, you can't buy that equity. But once they're included in the benchmark, they become part of the universe that you can take an active bet on. So I think there is those passive flows, but they're also being included widens the investor base who are allowed to invest in your stock. And we've done things well. We started, when I joined in June, July, we were 6% institutionally owned. The rest was retail investors with a heavy Asian fast money retail investor base. As of March 31st, we are 47% owned by the largest institutions in the world. Fidelity is our largest investor as of March 31st, which means you have these anchor investors who are buy and hold. So the combination of index flows being included in the index and being investable and having institutions who are owning you is a righteous thing. It doesn't change the price of the underlying, and we are largely a beta to the price of Ether.
Understood. Yep. Understood. And then I think the other kind of a key point there is that people want to understand what they're getting more out of owning SBET, right, over the ETH assets. So that's one thing, is you get these passive flows, these kind of institutional ownership. The other thing is that you guys have just announced a on-chain yield fund with Galaxy, $125 million, looking to get more value per share, more ETH per share of SBET using on-chain yield strategies. Give us the kind of high level here. What is Joseph Chalom's view on maximizing ETH per share for SBET owners?
So the good news is, for your viewers, Bitcoin is a great asset. I own a bunch of Bitcoin, but it's not natively productive. It's a store of value. You hold it, and you hope you're going to get the price appreciation. And in a digital asset treasury, you've seen MicroStrategy have to do financial engineering in order to get that yield, and you gear up the public stock. And that's still available on Ethereum. The difference is Ether has a native staking rate. We are the only DAT that was like staking over 98% from day one. But we also believe that we have a comparative advantage over you owning spot and trying to stake it yourself or buy the ETF, including the ones that I launched when I was at BlackRock. And the advantage is we are not a daily redemption fund. We have permanent capital or near permanent capital, which means we can deploy our Ether, not just in simple staking like we started, but you can start participating in risk-adjusted yield where you can deploy assets, your Ether, for a multi-year period, and in return, get higher rates of return. We did that in January, where we allocated about 200 million of our Ether into a liquid restaking solution with EtherFi and Consensus Linea. And by the way, we did that within a qualified custodian. The first time anyone had taken DeFi in a public company and done it within a bank-regulated custodian. This is just the next step in the efficient frontier, which again, if you have permanent capital, there are a lot of protocols who are starved for that initial capital to get off the ground. And if you can stay in your ETH, which is what we're doing, and make it available to protocols, you can have them over-collateralize that loan. You can have it be with high quality collateral, and you can earn an outsized yield on a risk-adjusted basis. And our partnership with Galaxy, we announced our memorandum of intent to launch this fund, will identify those protocols and be able to deploy for multi-year periods to those who meet the institutional standards of Galaxy and SharpLink. And then you end up having a portfolio that's largely, still majority, simple staked, but we can beat the Ethereum staking rate because of that competitive advantage. And I'm not here to knock the ETFs. They are great products. But if you're a staked ETF, you're likely not going to be able to stake 100% because you have to provide daily liquidity for investors who want redemptions. And you can't do that if you have a 40, 50 day on staking queue on your ETH. So we can provide not only the Ethereum staking rate on 100% of our assets, but we can outperform that from a productivity perspective. And for those who can't own the ETF, we're, I think, a smarter alternative.
Yeah, and I think that is the competitive advantage that SharpLink has beyond some of these other opportunities for exposure. Joseph, want to give you the last word here. We just got a minute or so left. I know you're busy championing ETH to all of the hungry institutions out there as well, but you mentioned you had some spicy takes. Last word to you. Want to make sure that we give you a chance to share any more or any spicy takes that you didn't get to already.
I would just emphasize two things. I think the industry is wildly underestimating the size that tokenized assets is going to be later this year and next year. It took 7 years to get to a $30 billion RWA tokenization number. You're going to end up seeing individual funds, multiple the size of that, who are going to be tokenized, and it's just going to be step function, and Ethereum is going to win 50 to 70% of that. So that's number one. And number two is, for those who feel really crappy, they have a bad bag, they've had a bad experience, they're in the dumpsters, they want to pivot from crypto to AI, they're just frustrated. At the moment when retail is capitulating is often the greatest risk reward period in the period that follows. You've seen that in the stock market, you've seen that in cyclical changes, and the smart money doubles down when the sentiment is bad, if you have the tolerance to think beyond a couple of months. So that would be my hot take. Focus on the long term, look at the signals of what the announcements are, and then you have to believe that Ethereum is going to win an outsized version of this, and Ether, the token, is going to be the in-demand token to secure those transactions. But look, we're in a winter, and you have to have the leadership to see beyond the next month, 2 months, and 3 months. That's very hard for retail investors. The smartest institutions are doubling down right now, and they're not experimenting, they're allocating capital.
It's a bit of a cold front, I would say, Joseph. For you, it's a cold front. Maybe for us Florida boys, it's a bit more of a winter. Thanks for your time, Joe. As always.
Classy, as always.
Keep stacking, man. Keep stacking. ETH is not dead. We're going to be here. Half this podcast isn't selling ETH. The rest of the haters aren't selling their ETH. Stay strong, Joe. We appreciate your time, man.
Great to see you guys, and I look forward to seeing you soon.
Absolutely. Yes, thanks again, Joe.
See you at ETHConf, man. Peace.
That's
Bro, what's your ETH take here?
Well, look, Joseph Chalom, classy as ever, part of the institutional champion strategy there at Ethereum. Look,
what's your ETH take? Do you agree? What's my ETH take? I saw you kind of pushing back on.
Well, look, part of the value of this show is that we can pressure test our theses. This is what I love about doing this show. It's why I show up day in and day out. And so what I do have is a thesis that is bullish ETH, and I have a time horizon that is on the scale of months to years. And so I absolutely agree that ETH is in a position to capitalize on the large swath of tokenized assets. You have the biggest, the brightest, the most valuable, and the most prolific financial institutions that have ever existed talking about tokenization. And you just had the former head of digital asset strategy at BlackRock talking about tokenization and why Ethereum is the home for the tokenized revolution, the tokenization super cycle. So I think that is number one, is you have this tokenization super cycle. Number two is the realization that Ethereum is the home and the ultimate landing place for, Joseph said it, 50 to 70% of tokenized assets, stablecoins included. And when you sum up stablecoins plus tokenized assets, you do reach trillions of dollars, and more so, an order of magnitude higher in the likes of 10 to hundreds of trillions of dollars of assets. And so, first, That is the base case, is that Ethereum as an ecosystem and as a chain will be the home of 100 or more hundreds of trillions of dollars of assets. That is where I think I agree with Joseph, and I think most people in crypto would agree. Now, it intuitively says that, yes, if this thing has hundreds of trillions of dollars of assets, you would expect that it would be a valuable thing. There would be, a ticker, an equity, or a share of this network would, essentially appreciate in value, and it would command, significant value for a share of that network because it houses hundreds of trillions of dollars of assets. That is the disconnect right now, and I think that's where the market is a bit confused, is how do we get from, a place where ultimately hundreds of trillions of dollars of assets tokenized, but ultimately a share of that network is a significant piece of value. And right now there's kind of two camps. You still have the ETH is money camp, or you have, hey, the likes of, this scale of assets is ultimately going to lead to a lot of activity on the network. People need to own ETH for gas and to pay for transactions on the network, and ultimately that is going to lead to a lot of people demanding ETH the asset in order to pay for transactions. There's two problems with that thesis. One is that the Ethereum ecosystem is scaling. We're decreasing the amount of fees that are charged per transaction. And so we're not going to need as much Ether in order to send those transactions on the network. Even if you have hundreds of trillions of dollars of tokenized assets, you're not going to need that much ETH in order to send those transactions. That's problem number one. Problem number two is that the tokenized assets themselves don't necessarily require a lot of transactions. This is kind of what I was getting at, is that right now, the high frequency of transactions when it comes to tokenized assets, it's happening on Hyperliquid and it's happening on Solana. I have some qualms about the Solana thesis here because ultimately I do think Solana is kind of a meme coin place, and you don't really have a lot of high frequency tokenized flows for high quality assets happening on Solana, but it is certainly happening on Hyperliquid. And I do think the rise of kind of these alternative trading systems like the New York Stock Exchange, the NASDAQ tokenized alternative trading systems will command a lot of value and a lot of volume when it comes to tokenized assets. The problem is that, people look to Ethereum for finality, right? For these tokenized assets. And even if you have hundreds of trillions of assets on Ethereum, it doesn't necessarily mean that you're going to overcome the scale of how we're proceeding with this network. We're decreasing the transaction costs. You need an exponentially more amount of transactions in order to burn ETH and lead to a rise in ETH the asset. The amount of transactions, the amount of assets on the network, that is one thing, but you need transactions on the network, not just assets sitting idly on the network in order for value to accrue to ETH the asset. And I think that is where I'm still not quite sold. I think there's been companies, Etherealize, SharpLink, Bitmine, that have done some data and digging around this. But what I'm really looking for is the math, right? If we have hundreds of, the math is this, right? If we have hundreds of trillions of dollars of assets on Ethereum, how much do we need to turn over those assets in order to lead to a significant amount of transactions on the network at a certain gas price in order to trigger the burn and overcome the amount of scale that we have on the network? That, I think, is it's not a very complicated mathematical equation, but if we're going to put aside the ETH is money thesis, which in my opinion, we've already seen how Bitcoin is money is playing out. We're using it to play out in a store of value thesis, but we're not going to see Bitcoin be used to pay for coffee. We're not going to be seeing ETH used to pay for coffee. I think we have to put aside that thesis. And I think, look, there's an institutional, equity-like play here, but I think that is primarily based off revenue. It's not based on, pure store of value thesis. So I think we have to put that aside. I think we have to focus on Ethereum and the revenue the revenue capabilities here. And I think it's a very, very simple, straightforward equation that we should be doing the math on. It's how much is going to be tokenized. 50 to 70% of that is going to land on Ethereum. How much does that need to turn over in order to lead to, in order to have some amount of transactions? And what is the gas price as we turn over those assets? All of that leads to the demand side of the equation. And then on the other side of the equation, you have the amount of scale that we're decreasing transaction fees. That is what we're seeing play out. And I think ultimately we're going to need the amount of transactions demand and the gas paid by the likes of people trading, holding, securing, custodying the entire economy around tokenized assets. We're going to need to turn over those assets. We can't just have them sitting idly. Otherwise, we're going to have this very, very low amount of transaction volume. Even despite the large amount of assets sitting on the chain, we need to turn over those assets to trigger the burn. And this is ultimately the pickle that I think Ethereum finds itself in. I'd be looking for some math here and shooting for some projections when it comes to the pace at which we're going to scale the network and the pace at which we're going to ramp up the amount of transactions via the amount of volume and assets that we have tokenized on chain. End rant. We're going to kick it over back to the guys at the tower. I don't think we need a little standby break, guys. So just stick here right with us. I'm going to kick it over to Andy and Ryan in the tokenization tower. And I have a feeling they're going to be talking about one of the top performing assets in the world, the thing that is catching a bid, the only thing that's not AI that's catching a bid. We know Andy's loaded up on the treasury company. We know Ryan and Bitwise have been sending these ETFs higher and higher. And we know Jeff is continuing to buy back his own token. Guys, it's none other than Hyperliquid live. We've got Ryan Rasmussen live, head of research at Bitwise in the tokenization tower. Let's kick it over to these guys. Don't go anywhere. You're not going to want to miss this.
Alrighty, guys, we are here live at the Tokenization Tower with Ryan Rasmussen, head of research at Bitwise, following the meteoric rise of both the Bitwise and 21 Shares ETF launches of Hype, notably other ETF products that they have, doing a lot of work in the space. Ryan, welcome to the tower. Good to have you on the show again, man.
Great to be here again.
Big week for you guys.
That's right. Yeah, exciting week.
Yeah, man, it is. Maybe just walk us through like the last week internally. What's been going on?
Oh man, well, so much goes into the lead up to launching one of these ETFs. You're working with regulators, you're working with market makers, you're working out all the operational nuances of seeding the funds, etc. But really, once it goes live, you see what all that work leads up to, and there's been tremendous adoption and response to the launch of these hyperliquid ETFs, right? And of course, the price going up has a function of to do with that and caused by that, but nonetheless, we're seeing tons of demand, obviously, for these things. The largest hype ETF in the world, so really excited about that.
Yeah, man. I mean, it seems like you guys caught a lot of other issuers asleep at the wheel on this one. Like, what happened there? Was it a regulatory thing? Was it a knowledge of the market thing? Is it just like being in the know? Like why was it just two issuers that got this done seemingly at the same time, and now Grayscale's kind of trying to catch up, and a couple others? Usually like the bigger names, let's call it BlackRock or some of these larger ones, maybe they wouldn't dip their toes into smaller assets. Like what happened here?
Yeah, I mean, it's a good question. There's always trade-offs here in terms of what assets ETF issuers want to focus on, right? And when you have crypto specialists like Bitwise, it's easier to survey the space, know which assets have strong narratives, strong fundamentals, and that we think are going to be long-term valuable ETFs to have in the space. Other asset managers maybe don't focus solely on crypto are also using their resources to file ETFs or build funds in other areas of financial markets. And so from that perspective, I think crypto specialists like Bitwise have an edge. That's why you don't see larger asset managers necessarily dipping their toes here. The regulatory elements of it do play a role, but you file for these things months and months in advance, and then it sets off these sequence of events and meetings with regulators, et cetera. And so it's not like it's publicly known that there has been filings for these, and then it all kind of plays out from there. But I think as crypto asset managers and crypto specialists, like we pay so much attention to what's going on in the market. We have 200 people at Bitwise who spend all day, every day looking at crypto markets. We have on-chain solutions, public funds, et cetera, and we talk to investors, and we've seen the demand for hyperliquid, both on-chain and from speaking with investors, build up for months now. And we're really happy to have the world's largest hyperliquid ETF now out there, staking natively in-house, and some other cool features as well that maybe we'll talk about.
Yeah, I saw that. I saw there's wallet trackers going crazy right now about the purchases of hype and the staking. And so we're going to get into that. We're going to get into the thesis. But I think there's still a bit of confusion on how these things work, even just from the top level with Bitcoin. People kind of assume that the ETF, $1 into the ETF is the equivalent of $1 of buying power on hype, but it's not always that straightforward and simple. Maybe you could just kind of unpack like the flow here, like educate us on how the flows work. People come in on their brokerage account, they buy the ETF, they buy, is it HY? What's the ticker?
BHYPE. BHYP. Yep.
BHYP. They buy that, right? Let's say they buy 100 grand of that. What happens then in the kind of back end to get that that cash or that asset into hype and then staking it? Like, is it just one-to-one? Walk us through like how these flows kind of work.
Yeah. So for the most part, it's one-to-one. Now when you go into your brokerage account and say you want to buy $100,000 worth of an ETF, you're buying it on the secondary market, right? Someone else who's looking to sell $100,000 that ETF is selling to you for the most part. And when there's more demand than there is supply, or vice versa, that's when you start to get these market makers involved and these authorized participants who actually go and take in the capital. They go and give it to the ETF issuer. The ETF issuer creates new shares of the ETF to give to the market makers. Then they go and sell those on the secondary market. So there is this kind of sequential process that happens, but you can think of it more broadly as $1 into a BHYPE ETF is going to go to buying hyperliquid, and then those assets are staked, and we stake in-house at Bitwise. And of course that helps investors realize more of the overall rewards because we're not paying a third-party staking provider some fee, et cetera. But $1 in, $1 into hyperliquid is really the best way to think about it.
Okay, and I haven't looked, into the whole prospectus and everything, but is the kind of memorandum here that you guys are operating like on a daily basis in terms of like equalizing the ETF? So if you have, how many inflows versus outflows, you guys are settling at the end of each day to make it kind of even?
Yeah, exactly. So ETFs have intraday liquidity, meaning that they are trading all day, every day, as opposed to like mutual funds, which strike a NAV at the beginning and end of each day. And so the thing about this is that our team is working with the market makers and what's called authorized participants and trading desks to facilitate this capital flow all day, so that the market price you pay for the hyperliquid ETF reflects the underlying NAV of the fund, and the NAV is just the net asset value of the underlying hype assets themselves. And that's a flow that's going on all day throughout the trading day. And then of course, the end of the day, you strike an end of day NAV, which is what it opens up at the following day. And you kind of just move throughout the trading week like that.
Well, I asked that because hype's been especially strong during the US trading hours as of the last week or so, like especially strong. And then kind of like dwindling a bit overnight. And then each morning, it seems like there's this, persistent flow.
Yeah.
So to get into the thesis a bit, Matt, your CIO at Bitwise, put out a tweet basically saying that everything clicks for allocators when they understand that the entire MO of Hyperliquid is to make a bunch of money on trading fees, take that 99% of those fees and go back and buy the underlying.
Right.
And I quote tweeted that yesterday and put out a clip about it and was basically saying like the incentives are so aligned here. It's very simple. If you are an ETF issuer, your MO is to get AUM. You want to be selling your products to clients and who are going to believe in these products and want to hold these products. Hyperliquid is a very easy sell because of all the features that it has. And so the incentives are aligned for Bitwise to go and kind of talk about hype to their institutional network because it just makes sense compared to a lot of L1s, other assets. Now, we don't need to get into the comparison game here, but talk to us about the appetite for allocators who have a traditional lens on investing when they hear about Hyperliquid and the over $1 billion or so of free cash flows each year going back to buy the asset. They hear the story. Like, what does that light bulb moment kind of more in detail look like?
Yeah, well, I mean, it really is a light bulb moment. When you think about traditional allocators, you really have to separate Bitcoin from other crypto assets because they understand the narrative for Bitcoin is digital gold. It's this digital store of value that serves the same purpose. And two things are true. One, they've accepted that gold doesn't generate cash flow. And so they don't need to get over this fact that Bitcoin doesn't. They can accept that it's an analogy, a digital version of gold. And two, not all allocators allocate to gold. And so naturally, they're not going to allocate to Bitcoin. You just have to accept that. Not everyone is going to invest in Bitcoin, just like everyone doesn't invest in gold. Now, going to the other crypto assets, once you get beyond Bitcoin with allocators, then they want to know, okay, if these aren't like digital gold, what's the selling proposition? Why does it have value, right? And then you start talking about cash flow. And it's been difficult, particularly in bear markets, but for a lot of crypto assets in general, it's been difficult to justify the valuation with the level of revenue that they generate, right? The level of fees that they generate. Hyperliquid, it's such an obvious story, and these investors allocate to stocks. They understand that, okay, you want to generate cash flow. That cash flow accrues to shareholders. You explain what happens with Hyperliquid, right? Generates fees on all of this trading activity. Those fees are used to buy and burn hype tokens. As a hype investor, that feels a lot like a stock buyback. It's just programmatic. And when you stack that up against traditional equities, it's a relatively high buyback, right? It's a larger buyback program than most of the companies in the S&P 500. I think the average buyback is something like 2% in the S&P 500, and it's something like 5% when you do the math on Hyperliquid, at least. So from that perspective, it becomes an easier sell. And our goal is to provide the best menu of investment options for our investors and then help them through that journey into which products they want to allocate to. And they all have different mandates of what they can't invest in, shouldn't invest in. They have different goals in terms of risk, adjusted returns and ratios and things like that. And so our goal is to help them on that journey. And we think Hyperliquid is a really important piece of that broader menu of options for them to choose from.
Yeah. Yeah. And so then let's get into kind of that conversation. I assume the question is, all right, bull case, bear case, what are my tail risks here? What do I need to understand what I'm investing in? Could you maybe just provide us what the bull case is here, what you see as like the opportunity and the TAM, and then similarly the bear case. What is the risks that you are educating investors on? What are the tail risks? What are the things that they should understand before looking into hype as an asset?
Yeah. I love that you asked that question because what I feel like a lot of the crypto industry doesn't necessarily accept or crypto natives don't accept is that investors have to look at both the upside and the downside, right? Yes, there's potential for high returns in crypto, but that comes with certain risks. And so we do educate on both of those things. The way that conversation goes is I think we first zoom out. When we talk about what's happening in the long-term trajectory for crypto, you have the largest regulators in the world. You have the largest asset managers in the world. Larry Fink, CEO of the largest asset manager. Paul Atkins, the most important financial regulator in the world. They're saying all assets are going to be on blockchains in the future. And they're not talking about 20 years from now. They're talking about 3 years from now. You see the regulation making its way through the SEC with Project Crypto and other initiatives where they're laying the groundwork. You see asset managers actively tokenizing funds and building out the infrastructure to do that. You see the NASDAQ working with Kraken for tokenized stocks. You see the New York Stock Exchange working on their own tokenized stock initiatives. Okay, so the big picture is assets are moving on chain.
Yeah.
How big is that market? It's literally in the hundreds of trillions, right? So the next question is, where are they moving on chain? One of the natural places they're going to go right now that is to the most efficient and the best technology, and Hyperliquid is up there with the best of them. They're extremely fast, extremely low cost. They do this trading extremely well of derivatives and spot. They're rolling out really interesting features, right? Like they just rolled out the ability to launch permissionless prediction markets. Okay, well, prediction markets is a huge market that traditional investors are hearing about all the time, every single day. They turn on CNBC, it's sponsored by Kalshi. They see a Wall Street Journal piece on prediction market, on Polymarket, et cetera. And so you start to talk about all these mega trends of stablecoins, tokenization, prediction markets. You talk about the infrastructure it's going to be on, and Hyperliquid is just at the top of that conversation every single time. And I think that's how the educational journey starts. And when you paint that picture for them, it makes it much easier to make an allocation because you actually have tangible points to reference, not only on regulation, institutional adoption, but on the fees that Hyperliquid is already generating before this transition takes place. And I think the nail in the coffin there on the conversation point with these investors is it's not just crypto assets.
Yep.
The Wall Street Journal, Bloomberg, other major financial publications are quoting the price of oil that trades on Hyperliquid on the weekends, right? The S&P 500 just licensed its index to trade perpetual futures on Hyperliquid that trade 24/7, 365. So you can actually see this playing out in real time if you're an investor. They're paying attention to so many other things in the world. Our job is to show them this is happening and help them understand how to get exposure to it.
Okay, so that's super bullish, and trust me, I was buying hype the first day. I am beyond elated at this conversation, but like, what are we missing here? Is there a regulatory risk? Is there a competition risk? Yep. Is there a DeFi exploit risk? Is there a security risk? What does that conversation look like when it comes to, Ryan, this sounds amazing. I mean, look, this thing's printing money. It's still kind of underknown, underallocated. Even within the crypto native landscape, there's a lot of people that are sidelined because they just thought it was another perp dex, too expensive, whatever, let alone the rest of the macro environment, global macro. What am I missing here? Why is this not so obvious?
So yes, there are risks, and we talk about those. And you brought up some really, really good ones that investors should know about and that we educate on. Regulatory risk continues to be one of the larger risks facing crypto. It's been de-risked significantly with the current administration, but there's reasons that the Clarity Act are so important, for instance, and why we need the SEC to finalize its Project Crypto agenda and push those things through is because you need this stuff set in stone in order for the next administration to not come and easily reverse it. Or you need it set in stone so that traditional institutions actually feel comfortable allocating billions of dollars, investing tens or hundreds of millions of dollars in this infrastructure for the long term. You've already started to see this play out, for instance, with stablecoins. Post Genius Act, we've seen so many traditional institutions start investing a lot of money in stable coins, right? You've seen SoFi just launch a stable coin for its, I think, 15 million users of its app, right? And you've seen time and time again developments in the stable coin front. MasterCard spending over $1 billion, Stripe spending over $1 billion on stablecoin infrastructure acquisitions. They only did that after the Genius Act passed because they were comfortable that there is now legislation in place that's not just easy for the next administration to reverse with an executive order, for a new SEC to come and reverse. Okay, so when it comes to Hyperliquid, the natural question is, are assets going to move on chain? Are traditional institutions actually going to be interacting with these blockchains, and how are they going to do it? And what's the DeFi privacy issue looking like? What about KYC, AML? There's all these questions. And so you need legislation in place in order for these institutions to feel comfortable knowing the rules of the road and to actually invest and take these steps forward. So the regulatory risk is there, but we need to get legislation in place to de-risk it even further. That's like the first risk out there. And I don't think that the Clarity Act, if it doesn't pass in the next 7 weeks or 8 weeks before the summer recess, that's not the end all be all, right? There will be chances to pass in the future, but we really would love to see it pass, of course, in the next 2 months before the midterms, before the summer recess. Okay, another risk, you mentioned this as well, there's smart contract risk, right? There is technical risk associated with moving your business onto this new technology, right? These blockchains. They ask about quantum risk when we talk about investors and we talk to institutions about moving on chain, right? Those are real risks too, and so we help them understand those risks. And then there is competition risk. I mean, you said that as well, and I think that's very, very true, right? We've seen time and time again, new L1s disrupt the existing L1 space.
Especially in perp dexes.
Especially in
There's
perp
been
dexes.
just a consistent iteration.
Right. People are talking about already that, there's hyperliquid disruptors, right? Lighter, et cetera. And so you saw Solana disrupt Ethereum. You've seen Hyperliquid kind of disrupt Solana, right? And so there's some competition risk. Now, this is why when we talk to investors, we talk a lot about position sizing, right? Don't put all your eggs in one basket. Most traditional investors wouldn't do that in the equities world. They wouldn't do that in the alternative assets world. And so they shouldn't do that in the crypto world. We're big fans at Bitwise of indexing or buying a basket of crypto assets to play a specific theme. So, okay, you want to invest in the growth of stablecoins. You want to invest in tokenization, every asset in the world being tokenized. You should buy a basket that represents that theme. And we're happy to help them build those baskets or run model portfolios for them. We have index funds as well that do that for them. But a lot of investors want to take those positions and add satellite positions on top of that. Maybe they want broad exposure, but they want to be oversized or overweight hyperliquids. Then they'll add a hyperliquid ETF on top of that, and we help mold the way they're thinking about and educate on the way they're thinking about how to build a comprehensive crypto portfolio. So it's risks, it's rewards, it's about having broad exposure, but also making sure you're exposed to the right themes and that you're going about it in a smart way.
Amazing. So just this week, we saw the Hyperliquid Strategies treasury company, ticker PER, came out and announced that they have like a weekly update on their financials. They sold about $120 million they issued about $120 million of their own stock, sold it, raised a bunch of cash off that. I think $40 million of cash, bought about a 1 million hype, I believe, in the last week or so. And so they raised their cash by about 40 million. It's about $150 million of cash now. And they have, I think, 23 million hype under this treasury company. One of the only treasury companies in the entire market that is like timed things somewhat well and also picked the right asset. When it comes to the growth of the treasury companies in Hyperliquid, specifically with PER, how does PER affect the investment thesis for Hyperliquid as an asset? Obviously, they're just trying to continue to accumulate this thing. They're sitting at about 1.19x MNAV, so they are able to continue to hit that ATM to buy more hype. In your mind, is this kind of like negligible? Is it important? How do you think about Hyperliquid Strategies contributing to continued growth of hype?
Yes, well, love the ticker, by the way. It's just a fun sounding ticker. It's not negligible. It is important. I think for one, it's a simple supply and demand story, right? You have more demand coming into an asset than there is new supply or supply issuance, then you're going to drive price up. That's just simple economics. And so when you have the ETFs buying hype on the open market, when you have the Hyperliquid systematically buying hype on the open market and burning it via the fees generated from using the platform, and when then you have companies like Hyperliquid Strategies raising cash and using that to buy hype on the open market, all of those things are the demand side of the equation. And when you stack those up against supply, that's when you can start to realize, okay, where's this thing going? And you can explain why the price has done so well over the past week, right? Beyond demand on hype itself, I think it's really important to have these companies in these spaces, whether it's Bitmine and Ethereum, or whether it's Hyperliquid Strategies and Hyperliquid, that are building around the space, right? Or you just had Joe Chalom on, right? And they're also doing the same thing for
championing
You're championing adoption. You're investing in the infrastructure around the space. You're using the protocols, right? Like you're using DeFi. You're helping to boost liquidity and boost the brand name around these things. And you're buying the asset and you're holding it or you're staking it, et cetera. Like those are all important things. It also provides investors who maybe have mandates to only invest in public equities. It provides them a way to gain exposure to these new technologies and these crypto native systems through public equities, right? So we work with, for instance, endowments, foundations, et cetera. Some endowments or some foundations have mandates that they cannot invest in commodities. They simply cannot invest in commodities or single asset commodities, right? They can't buy a gold ETF. They can't buy a Bitcoin ETF. They can't buy a Hyperliquid ETF. They certainly can't invest in crypto assets directly because of operational nuances, et cetera. But what they can do, because their policies enable them to invest in public equities, and because operationally they're set up to invest in public equities, they can go buy a hyperliquid strategies company, right? And they can have that exposure. And then any alpha hyperliquid strategies can generate on top of the underlying price exposure to hyperliquid is a plus for those investors, right? And so I think it's really important to have these companies in the ecosystem, bringing awareness, bringing demand, and bringing liquidity into the ecosystems. And so I love to see what hyperliquid strategies is doing. And if I had to guess, we're going to see more hyperliquid DATs pop up.
Amazing. And I agree. I mean, they've executed quite well from a top-down perspective, have done well. I have, a good sized bag in Perb and been very, very bullish on Shams. I always have to do a disclosure here.
Yeah.
And so when we're thinking about some of the circumstances of events that have happened and kind of like the order, one of the things that happened like about a month ago was this Circle Coinbase USDC deal with Hyperliquid, which is another demand driver that we haven't quite touched on yet. One of the things that we heard from the leading liquid staking provider Kinetic on the Hypercore and Hyper EVM team was Hyperliquid does not pay for anything externally. Market makers, they don't pay for integrations, they don't pay for any of this stuff that a typical kind of L1 would. And in some sense, that's slowed them down. They've, it's been harder to do certain things. It's been harder to get certain things done. But they have these different teams now. The Trade XYZ team has kind of came in as its own external team, but part of the team, Jake Travinsky in DC, has now kind of stepped into his own kind of team. And so you've got all these little teams within a team. But of course, the claim to fame is like 11, 12 people on the team. Now, with that being said, this Coinbase and Circle deal was specifically unique because in most cases, Circle and Coinbase like to strike deals where the revenue split is heavily favored to them for the liquidity, for the native issuance, for all of the Lindy effect that these companies bring. In Hyperliquid's case, it's actually quite the opposite. Most of the revenue, I think to the extent of like 90-something+% of the USDC that is about $5.5 billion now, I think, on Hyperliquid, on Hypercore, will actually be given to the assistance fund and used for buybacks. How did this specific event change your view on the regulatory risk, on the revenue risk, on kind of Hyperliquid's dominance? What did you think after this happened?
Look, there are certain moments in a journey of, let's just call it, even though it's not a company, because it's an easy, it's an easy mental model to use. There's certain elements or certain events that happen where you're like, oh, okay, this is like, it's happening now. Like, this is a step change in how their business operates. They've shown that they are powerful in this ecosystem, that their brand name holds a lot of value. And I think this was a moment where you saw that happen. I mean, I think you're absolutely right. Typically, you don't see these types of deals where the issuers, whether it's Circle or Coinbase, whether it's distributor, have less economic capture of the deal, right? But in Hyperliquid's case, to your point, this just grew their revenue significantly. But I think it also bolsters adoption of USDC, right? And that's why you would see Coinbase, who has incentive to do that, and Circle, who has incentive to do that, want to do this deal, right? They want to grow USDC into the world's largest regulated stablecoin. And if you're looking at ecosystems like Hyperliquid, where tons of trading activity is happening, whether it's perps, now spot, prediction markets are headed that way, it makes sense to want to make your stablecoin the staple of that ecosystem, right? If they could have gone back in time and done that for Solana, they would have done that, right? And so I think that's the reason why they would do something like this. Overall, it's going to drive a lot of demand into the USDC stablecoin. That will grow over time, more liquidity, more dominance across different blockchains, more supply, more revenue, et cetera. And so it makes sense for them to do it. It's a great boost for Hyperliquid, right? And I think when you think about, to your point of regulation, like where's this thing headed? The ability for Hyperliquid to say, look, we have the world's largest regulated onshore US-based stablecoin as like our preferred partner, if you will, for lack of a better term, and it's dominating what the stablecoin usage is on top of this platform. That's a great point to make to regulators when you're working with them. Or showing them what your business looks like. So it's a win-win, in my opinion. Of course, it's a win for Hyperliquid, but I think it's a win for Coinbase and Circle as well.
Yeah. Well, I think it contributes to this vision of being kind of like this house of all finance and being able to have that regulatory, arm, right, with these two players. It brings a lot of firepower in DC and also a lot of credibility and legitimacy, and then perhaps up to the tune of $125, $150 million of annualized revenue from the the treasury bills underlying the USDC on the blockchain. You know, that is rate dependent, but you know, that is another nice boost to the assistance fund. When you're looking at like the TAM here, right? People often compare Hyperliquid to Binance, Bybit, some of these other exchanges, but then you've got like the larger view of the NYSE, the CME, NASDAQ, and these guys are not going to go down easy, and they're not friendly opponents, right? Talk to us about how you see Hyperliquid's progression from like a crypto exchange to comparing to Binance. I think they hit like 17, 18% of OI on Hyperliquid comparatively to Binance, I believe. Don't quote me. But like we're taking a much bigger swing here. Those guys aren't going to back down easy. What is your mental model for maybe how that could play out, what that comparable looks like, and that evolution?
So I think that the TAM of what crypto is going after is insanely massive. It's literally measured in the tens of trillions, if not larger. And I think the surface area that crypto has scratched is tiny, right? So overall, the market for that these markets are going after is huge. The penetration of those markets is minimal. It's going to grow significantly over time. So it's important definitely to look at Hyperliquid's share within what we already have as the perps market, right? And you referenced the stat against Binance in terms of OI, and I think that's the right number as well, right? And that's impressive because it's a relatively new system. Binance has been around for a very long time, and it's starting to build and hit all-time highs once over and over and over again in terms of its share of that perps market. But Hyperliquid's also growing its spot volume business, right? It's getting into prediction markets. It's probably going to launch other products, right? We're only at HIP 4. Who knows what HIP 5, HIP 6, HIP 7, HIP 20 brings, right? All of these things will help them address these other huge markets that crypto in general is going after. The reason why I think it's important to think about the overall size of the market that crypto is going after is because you will see crypto's share of the market grow, and then Hyperliquid's share within the breakdown against Binance or other firms also grow. And I think that's net positive for Hyperliquid. Look, we're so early in the journey of these things. There's a reason that you can have an ecosystem like Hyperliquid, which is relatively new compared to other blockchains and other L1s, do so well and grow into the 10th largest crypto asset in a matter of years, because this is just such an early space. Yeah. It's really hard to look 20 years out and say who the winners and who the losers are going to be. It's easy to say, I think this company is going to be, or I think this ecosystem is going to be a winner. But what we tell investors is that having broad exposure to the space is a safer bet than choosing individual winners or losers. And that is true if you would have gone back and invested in the internet in the late 90s, early 2000s, right? Do you want Google or do you want pets.com? You probably could have just bought a basket and had both, and you would have done just fine.
Yeah. One of the questions that gets kind of thrown around with regards to this point here is, what is the actual market cap of Hype? And there's like conflating numbers. If you look at CoinGecko, or if you ask somebody else, when your investors are looking at the PDE ratio of this thing, I think it maybe is around 50, you could say right now, depending on the numbers. What is the like what market cap numbers do you guys go off of? Or like what is because there's this kind of issue, right, for the audience where there's these unlocks, but effectively the unlocks are only to the team because there's no VCs. And so we kind of have this trust in the team that they're not going to unload on the market. And so and then you've got the assistance fund, which is also like, there's no rules around what can be done with that, right. but it's almost like Satoshi's wallet, where it's never been touched and it will just only been added to and never been withdrawn from. What is the right way to think about the market cap structure from a circulating market cap and an FTV market cap for Hyperliquid? How do you explain this situation to your investors?
Yeah, so the things you noted are really good things when you talk about risks as opposed to your bull case, and things that you use to level out your bull case. So I think it's important to think about these things. To be completely honest, people who are buying the Hyperliquid ETF, if you're a financial advisor or you're an investor that spends most of their time in TradFi, you're not thinking about these differences between like FDV and float adjusted market cap, et cetera. Like they're just not there yet. They're not calculating PEs on Hyperliquid. They see this thing that is hitting escape velocity. Of course, price helps lead the narrative. And they want to have some exposure to these mega trends of stable coins, tokenization, prediction markets, et cetera. They're not really that focused on PEs today, right? They think, okay, these are huge markets that are going to grow over the next decade. Let me invest in them now, like early stage tech, right? Rather than trying to figure out where does it fit amongst like the PE of the other companies in the S&P 500.
So they're like somewhat price insensitive investors at this current point.
Yeah, I mean, institutional investors for the most part are long-term oriented and they're systematic, right? They're of course those that are trying to trade in and out of these markets and stuff. But when they think about making crypto allocations, they really are betting on crypto as a theme, crypto as a trend. It's a small portion of their portfolio. They don't really have time to get into the nuances of like FDV versus like circulating supply and unlocks. It's just not something to think about. Their thought process is, am I hearing that every asset in the world is going to be tokenized? Am I hearing that the Wall Street Journal and Bloomberg is quoting the price of oil and that the S&P 500 just licenses index for Hyperliquid, et cetera? Yes. Okay, great. Where's that all happening? Oh, it's happening on Hyperliquid right now. Great. I should probably have some exposure to that in case these things are true. I should minimize the impact on my portfolio if they're not true. And that's why they balance their position sizing. And it's not 50% of their portfolio. It's not 20% of their portfolio. In most cases, when we talk to investors, crypto is anywhere from 2 to 5% of their portfolio, and they split that across many different crypto assets. Now, of course, there are investors, financial advisors, wealth managers who have zero crypto, and there are some that have 10 or 15 or 20% crypto. But most of it balances in like the 2 to 5% range, and it's split across several different crypto assets, and they just want broad exposure to these mega trends. And Hyperliquid is one of the things that gives them broad exposure, but there are many other things as well.
That is extremely, extremely bullish.
Yeah.
That is extremely bullish. So just to kind of close this out here, is your take here that then hype as an asset continues to be undervalued currently, and that there is a price appreciation that is, yet to be had directionally? Like, how do you reconcile all of this into a directional thesis?
Yeah. So there's a lot of crypto assets out there, and for most of crypto's history, it's been difficult to align the growth of this ecosystem with the value that's passed on to token holders. Hyperliquid is one of those newer crypto assets in this kind of post-Gensler, post-Biden regulatory world that's figured out how to do that in a remarkable way. So yes, do I think if we're correct that every asset in the world is going to be tokenized, that stablecoins are going to go to $3-5+ trillion in the next 5 years? If you think that capital markets in general are going to be risk on, then yes, I think there's room for Hyperliquid to grow. Its share of the market's going to grow, and the market in total is going to grow. Those are both kind of bullish tailwinds, right? We believe the regulatory environment is going to be more supportive of crypto than less supportive of crypto going forward. That bodes well for Hyperliquid and other crypto assets. Yes, incumbents are going to fight it, but I think that happens with all new technologies. And when you have an innovative technology like crypto, like blockchains, like Hyperliquid, those break through kind of the walls that incumbents and regulators put up. We've seen it happen time and time again. It's not new to crypto. It's not going to stop crypto. And so I think that escape velocity to us is going to happen, and just making sure that you have exposure to these mega trends is what we tell investors that they want to have, because you don't want everyone to have been saying that these things are going to happen and then have to look your client in the eye 5 years from now when stablecoins are 5 trillion or when tokenized assets are 10 trillion and say, oh yeah, I heard about that, but I decided I didn't want to have exposure to that.
Yeah. Wow. I mean, guys, we have some of the largest allocators in the world buying what we've been preaching for over a year here. Ryan, thank you for your time. Thanks for joining us. Congratulations on the successful launch.
Yep, great to be here in the tokenization tower. Would love to come back sometime.
Thanks to Bitwise. Thanks to 21 Shares for bringing this asset into the institutional allocators' hands. That wraps up our show for today. Ladies and gentlemen, it is May 28th. You're watching The Rollup live from the financial capital of the world. Tomorrow, we will be back at 12:30 p.m. Eastern, per usual, with a lot for you. See you guys then, and thanks for joining us.